GETCRACK. Wake up, motherfucker.
Tesla shares are soaring. Earnings of 72 cents a share, a pretty good beat on 58-cent estimate. Revenue just shy of expectations. Investors focusing, though, on this prediction from Elon Musk on the call afterwards.
To take a bit of risk here, I do want to give some rough estimate, which is, I think, it's 20 to 30% vehicle growth next year. Notwithstanding negative external events, like if there's some force majeure events, like some big war breaks out or interest rates go sky high or something like that.
Joining us now, Tim Higgins, Wall Street Journal business columnist and a CNBC contributor. He does say, Tim, that these are just my best guesses. I don't even know if anything goes into his best guesses. But the first, so far this year, I think deliveries are down 6% or something. So to go to 25 to 30, that takes a leap of faith. But I'd never discount Elon Musk. But he just says, look, this is just a guess. Is that something that people should buy the stock on?
Just rolling the dice, right? No, it's back to kind of that optimism that investors like about him. It's kind of been missing in the last few years, that kind of target of potential growth. It's not the 50% year-over-year growth that investors were accustomed to in the past few years, but it's back to, hey, things are going to be exciting, and this is a growth story. This is a growth stock, and you have to have growth to kind of fuel that enthusiasm. So I think investors are excited about that. They're also excited about not just the profit that they saw, but the kind of the profitability. Those gross margin figures are exceeding expectations, and back to kind of some of the glory days that they remember from a few years ago, that had kind of gone away as he was chasing growth that wasn't the same kind of growth and it wasn't the same kind of profitability. So those two levers, people are pretty excited about that, I think.
It's all so multifaceted and interesting that, yeah, profits are the margins go up because selling the regulatory credits to other companies is 100% profit margin, and they got that stuff. Pure profit. Yep. And the other companies are like, please, sir, can we help? They need those regulatory credits. It's interesting the way it works, but profit is profit, and he's going to use that 10 billion. Or not 10 billion, he's going to use 10 billion for AI and robotics and everything else, autonomous driving. Don't you think investors also like that he's not going to do a $25,000 cheap Tesla? He says that he's not going to do a $25,000 cheap Tesla. He says it makes no sense, and they're going to work on the cab or the robo-cab instead.
Well, you're pointing out an interesting dynamic here that Tesla, a unique strength that it has. The EV market is struggling right now outside of Tesla, and automakers are pulling back their plans. And because they're pulling back plans to sell EVs, they've got to buy these regulatory credits around the world. But Tesla benefits from that. They're out there as the leader in EVs, and then they're benefiting from others struggling there, and then they're able to take that money and invest it in AI and invest it in autonomous cars. Now, the idea that he's giving up on the $25,000 car that you will drive as a human, I think really rattled people at the beginning of the year. He's just confirming what the market had already kind of had digested on reports earlier this year. So I think people are beyond that, and now seeing the actual car and seeing some timelines for putting autonomous vehicles on the roadway in the next few years, there's that thing to be excited for again.
Subsidies are one thing, but I mean, the regulatory credits, this is basically thank you, Uncle Sam. I mean, that's what, or wherever these are being sold. That's not like an operating. It is and it isn't, right? And you can't say it's not non-recurring either, because they probably have plenty of these in the future to sell too. So I don't know how to look at that. It doesn't. It looks almost like government assistance.
It's one of those things that over the years has just kind of been hanging over the company. It's been there. It has gotten bigger, and it looks like it's going to continue to be an important part of the company, as we just talked about the issues the other competitors have. But you also have this interesting dynamic where Elon Musk is out there with his political hat on saying he doesn't want government help, and that, and that he doesn't want this stuff, and siding with Donald Trump saying the government shouldn't be helping this stuff.
Yeah, and it's, no one's expecting it to turn it down, I guess. So what about the timeline for the no steering wheel, no pedals? That's really happening near term?
Well, it's super ambitious. The idea that maybe in California and Texas, he could be having Model Ys out there in autonomous mode driving, that's conceivable. We see Waymo out there. But the idea of putting a car on the road without steering wheels and without pedals, that's a big lift. That requires some special permissions and a lot of regulatory issues ahead. Just the idea of putting a robot taxi in California is a lot of paperwork for Elon Musk and Tesla that doesn't appear that they've actually begun. They're not running vehicles in the state without people behind the wheel currently. And so the idea that they're going to have a business out there doing that in the near term is, well, that's very ambitious.
Average selling prices for the models were down, and that, again, the regulatory credits offset some of that. Around the world, how was China?
China's helping, definitely. That's a big part of the business now. It's interesting. You hit this interesting point where Tesla has been having to decrease its prices to the consumer to improve sales, to help that sales growth. The final quarter of the year, the guidance kind of implies that they're going to have which they should be having a blockbuster sales year, a quarter, if you will. That's probably going to require some price discounts, according to some experts. And so you've got this interesting dynamic where you're seeing prices are down, but yet their gross margins are up. So it kind of, once again, indicates that they've been able to take price and the cost out of some of those vehicles, and also helped by the regulatory credits.
I do like the optimism. He wants investors to view Tesla not as a car company, but as a robotics and an AI company with an eventual market cap of 30 trillion, in his view. I just like saying 30 trillion because we couldn't believe, we couldn't believe when a company hit $1 trillion and then 2 trillion and then 3 trillion, 30 trillion.
You think $1 trillion is cool? 30 trillion is really cool.
Right. Why is that the ultimate? Does it end? Does the market cap stop there? The company just doesn't keep going?
What's the time?
I think for now we need to stop at 30.
What's the time frame on that?
Yeah, exactly.
I was thinking, I hope I'm there to watch it happen. That may take the singularity for me to, Tim, we might need we need to be part silicon and part human for us to see that maybe. Either that or I'm going to go back to, start going back to church every Sunday. If we don't get close enough on that.
Going to come down to the wire. Is this a bit of a surprise since the offer from Boeing did offer considerable pay increases, but not what the workers wanted?
It's not a surprise given what we see is a 64% of members voting to reject this contract. So it still shows quite a large majority of workers not happy with the deal that was presented. And so for Boeing going forward, clearly it has to put more money onto the table in order to get this vote passed. And clearly by a sizable number that are rejecting this. And you have to look at what happens next. Clearly this is a risk for Boeing because it is that threat from a ratings downgrade, a downgraded junk, given the prolonged nature of this industrial action, which is into its 6 weeks and longer. And so this is a blow because it's not able to produce the planes it wants, particularly of its cash cow 737 MAX, and therefore it's being deprived of revenue. And ultimately, the new CEO, Katie Upward, cannot fix the wider things that he needs to do to get Boeing back on track ultimately, and that's the wholesale restructuring of this great aerospace company.
Yeah, you mentioned, right? They're losing about $100 million a day in lost revenue as this strike continues, Danny. What can Boeing do at this? What's next? I mean, in terms of how far apart the union is with the company, what are we talking about here right now? What can Boeing do next?
Well, it does show with this vote result that the company and the unions are still quite far apart, and this is despite the intervention from the Biden administration. And the risk is the longer this goes on, the longer this is out of the hands of the current Biden administration, potentially, as we fall into the election period. We're not too far away from that. And so Boeing clearly is going to have to offer a lot more money, but to what end it can get around the table with the unions quickly to up its offer. And because the rejection, as you mentioned, Steve, the pensions issue, that is not going away. Something that was changed in 2014. That would be a substantial amount of money that would be Boeing would be giving up on. And so it probably doesn't want to do that. But maybe more money on the wages side could bring this strike to a conclusion.
Danny, what does this mean longer term for Boeing? And obviously, there's been the delays of the next generation 777X. Where does this put Boeing at a competitive disadvantage as it tries to obviously bring out its next generation aircraft?
I mean, the disadvantages are really that it still has a product, the 737 MAX, for example, which it can't produce on a fuller scale. We've heard Kelly Ottberg talk about wanting to produce a new aircraft, potentially to replace the 737 MAX. But Boeing and Kelly cannot focus on that whilst it still has this strike to contend with, whilst it has to restructure the entire business, particularly around just the commercial jet business as well. So there's a lot of headwinds here that the company is trying to manage overall, and particularly with the strike and the cost, the cash it's burning. This is a real distraction right here, right now.
Interestingly, of course, the headline there, returning to growth in the first time in 2 years. And with that in mind, you think about the rough year that UPS had. Is it fair to call this a relief rally?
Yeah, I think so. And I think it's showing that the stuff that they've been doing from a productivity standpoint is starting to pay off. That coupled with the fact that they're becoming more of a focused parcel carrier with the recent divestiture of its freight brokerage business, Coyote, to RXO, it just seems that things are going well for them, and they're just becoming a lot more productive, and they're expecting, their revenue per piece in their domestic business in the fourth quarter, that growth to outpace their cost per piece. And a lot of that is being driven by some of the pricing initiatives that they have, whether it's a peak surcharge, a peak season surcharge, or the fact that they're going to, price their product if they're harder to handle. So if it's not conveyable, so if it can't be automatically put through their system, they're going to charge a higher price for that because the additional cost that comes with it.
Now, one thing I'm wondering about UPS in particular is how sustainable these results are as well. You think about some of the demand coming from the Postal Service deal that they have as well. Can this type of performance now be repeatable now that we've seen the best numbers in 2 years?
We're pretty optimistic about UPS in the near and the long term. Like I said earlier, some of the productivity and cost initiatives, unquote, will really pay off when the initiatives that they have will really pay off when the economy, quote unquote, normalizes.
All right. What's up, guys? Good morning. Good morning. What's up, Blacks? What's up, San Jose? Yeah, StreamYard's got some weird thing where it just pauses everything or 4 seconds or 3 seconds before a video ends sometimes. Very weird glitch. No idea. No idea where that comes from. So, you saw that. Tesla's doing very well. I think last I saw it was up 18%. So, very good for the NASDAQ. So anybody that was gambling on NASDAQ, 20% now. Yeah, anybody gambling on NASDAQ or Tesla from yesterday's dip, good to you. You made a nice trade. Very nice trade. So we're going to enter into next week's big tech earnings all around Halloween. For some reason, everybody is all around Halloween. You got Google, you got Microsoft, you got Apple. Man, you got Amazon. Like, you got the big four there all ready to go. And semiconductors, we have AMD and Intel. So 6 companies, all big, all going to affect the NASDAQ. So will the NASDAQ pump right into Friday, next Friday? And next Friday morning, we will have unemployment numbers again. So it will be a huge week to end the month of October. And that's going to be really, 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 really affect how I would bet on election day into Jerome Powell 2 days after. So my guess is that we are at least going to pump into Thursday. I'm not sure because, well, unless Intel kind of messes it up, but I don't know. Intel's always a problem. And you saw Boeing right there. Like, so Boeing has pretty much lost any gain it made yesterday on the strike continuing. And so Intel being a big component of the semiconductor index, because Nvidia doesn't report until way after. They report late, way after elections. And Nvidia will be the key linchpin. So even if Nvidia doesn't go anywhere, goes sideways for most of next week into elections, doesn't mean like the NASDAQ can go up, because if everything else in the semiconductors goes down, yeah, I'm not sure. So I'll show you this. I'll show this chart. Because, yeah, you really have to understand what's driving the NASDAQ. It hasn't been the let's see, yeah, blah, 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 blah. It definitely has not been. Yeah, it has not been the big tech companies where you consider them software type companies or big data type companies right now. So FDN is an ETF. So you can see here, this is what mostly like Facebook, Microsoft, Google, Amazon, that stuff right here. And Apple's not included in this one, so no, it's not in this. But let's just put in mostly the software guys. And then you look at the semiconductors. See, you see the difference in shape here? Well, let me use a cleaner one. So I'll use a different index so it's cleaner. So you can see like there's a difference in shape. And when I do the ratio, like let me do SMH over the NASDAQ 100. Okay, so you see like the semiconductors is definitely leading, right? The NASDAQ itself 100. But if I do just the cloud stuff, the big data guys, so the FDN ETF versus the NASDAQ, look at the difference. See, that's a big difference. So the relative strength of those Google, Microsoft, Meta, and whatever, even though they're going up, they're not going up as high as the NASDAQ 100, which is being led by semiconductors. Okay. See, you see the difference there? So you know what's driving the market. That's why I keep going back to the semiconductors, because you have to understand what sector is leading. So you know what index is leading, NASDAQ. What subsector of that index is leading. So XLK is the component of technology of the S&P 500. XLC is the component where it's mostly like AT&T, T-Mobile, Google. So kind of like more utility types communication stocks. So when you look at the charts by themselves, you can't really see much of a difference. You might think like, oh yeah, well, they're all going up, but you see this huge drop in 2022, and all it's doing is trying to catch up to what it lost from that time when the interest rates went up. So it hasn't really been outperforming, because when you look at how XLK is looking, see, it's more smooth, right? It has a less steep drop from the 2022 era and more of a nicer climb to overtake its previous high there. So that's why we still have to wonder, okay, what's Intel going to do? Because Intel is complete trash right now. It's right back at the 2012, 2011. So it lost all of the semiconductor secular growth. And I talked about secular growth last time. Okay. So when you look at companies like that, like look at AMD, right? Boom. Even if it dropped, this trend is still up. When you look at Intel, it's completely failed. it tried to return back to its 2021 highs up here, but it just dropped right there. And actually, if you just look at the chart, if you just look at these indicators, so I haven't talked about these indicators. I kind of briefly showed you that by showing you a video with Joe Rabel, and like once you see this huge loss in momentum and strength. So this is a monthly chart, mind you. This is over months. Like when you see stocks that drop this far and you see them recover like this, don't bet that it's going to have a V-shaped recovery and just shoot right back up to the top and get out of here, because you see the momentum try to get up, but it's not strong enough to get over this zero line. So this is a MACD indicator, and it just rolls over. This is a classic thing that happens. So when it drops very far, it just does a recovery. It's just a recovery, but it's not a real recovery. It's just temporarily exhausted all sellers here. You get some temporary buyers that just want to chase it up because the buyers down here were like, okay, I'll buy at this price and we're going to hold it, right? We hold it at this level, and that's enough to have one juice, because this huge candle here looks like it was like a false move, because everybody was like, oh, well, maybe Intel's coming back. But that was just false, because that temporarily got up back here. But then, the real structural problems of Intel is still there. So the buyers up here feel like they bought at a too expensive price. So they start leaving. And then all the other guys that were chasing up here just start leaving too. And that just causes a real quick collapse all the way down. So after 2-3 bad earnings, yeah, you can't make it up. Now you're just like right back here, which is a very bad position, because it will probably need to make one more drop. Maybe it can hold 20, but if it can't, if all the earnings next week are bad, and then Intel reports at the end of all those earnings, it's like, yeah, it's gonna look real bad, right? So I don't know what's gonna happen next week. I'm not gonna be gambling on earnings, but I would say, like, for me personally, I think from what I've seen from the results from TSMC and the AI spending is good right now. And I'll show you some AI videos right now to maybe hype you up. So maybe these guys are just drinking the Kool-Aid and they really think AI is the shit. But here we go. Let's go to the first one. Let's go to the first video. Oh, Vertiv. Let's see, Vertiv. This is one AI stock. Here we go.
A volatile day for Vertiv. Shares down as much as 7.5% pre-market, then briefly in positive territory, down about 3% right now, despite strong results and better than expected Q4 earnings outlook. The revenue guide, however, came in at about the midpoint of street expectations. That, along with what Jim Cramer called ennui when it comes to the outperformers, could be pressuring shares today. But Vertiv is up more than 700% over the past 2 years as the AI boom fuels demand for the company's data center cooling systems. Joining us for more in an exclusive interview is Giordano Albertazzi. He is the CEO of Vertiv. Gio, it's great to have you here. Welcome.
Well, thank you for having me.
What would be your message to investors who are skeptical maybe that the gains that you've seen recently can continue?
Well, we have posted a 37% trailing 12 months order number. We have very strong pipelines. Our pipelines measuring the volume of commercial activity have been constantly growing and growing quarter to quarter. So we believe we are in a very strong position to really enjoy the benefits. So the acceleration of demand that AI is driving to the entire data center industry. And we are a leader in the data center infrastructure. So I'm very optimistic about the future.
And obviously the share price has reflected that, and people are still looking for big gains when it comes to AI. Do you think that positive momentum can continue for 1 quarter, 2 quarters, 6 quarters, 12 quarters time?
Let me talk about AI in general and building the infrastructure for AI. This is a very, very early stage of whatever AI will be. Probably another revolution, and it will go on for quite a long while. So I'm very optimistic, and I'm also very, very optimistic about Vertiv's strength in this space for both the power and the thermal part of our portfolio. We are essential to the industry for the growth, and we're seeing that in our numbers.
What do you think differentiates you from, there are many others who do this, some established companies who are in this space, others who are going to be startups and trying to go after some of these sizable profits. What's your moat?
It has decades of experience in the industry, certainly an extremely strong R&D, let's say, strength and tradition and investment. We are a leader globally in a digital critical infrastructure. So in that also, we play with the biggest, we work with the biggest players, both on the customer side and on, example, the NVIDIA defining the technology of the future. So not only is our ability to scale, our certainly very strong presence today, but the fact that we can, with our customers, ensure that they are future ready and that they will win in the AI market.
Understood. I just want to mention as well, correct me, were you guys a SPAC?
We were a SPAC, de-SPACed in February 2020.
Why did you go that route? And that whole sort of opportunity of going public, that route has not had a great reputation, but you guys are probably the most successful of all of them.
We're a very strong company. We were a very strong company when we de-SPACed, and we are a stronger company now, a real strong business with a lot of good fundamentals, and our performance is showing us. So I don't want to comment about SPACs in general. I think Vertiv was a very strongly positioned company in a very good market, and our performance is demonstrating that.
Final question, as we get more attention focused on just how much electricity is being used by data centers. I've heard, it's 10% of all U.S. electricity demand or something like that, and how much power that is going to require and how much generation. Is there anything from your point of view that can be done to make this process more energy efficient or anything like that?
Well, energy efficiency is built in everything we do. We deliver products and systems and solutions that are constantly more energy efficient. But if you think about the data center industry as a whole, is an industry that is built on electricity. So the electricity has an opportunity for being long-term sustainable. But it's right. Data center demand is growing, and so is the power for data centers. That will continue, and the industry is getting ready for that. But more and more efficiency, and over time, also heat reuse as a form to make sure that that energy can be also utilized for other purposes.
You are headquartered, I understand, in Westerville, Ohio. It's a popular state right now with the election coming up. Is there anything there that could change the trajectory of your business based on the outcome?
We look at the market, we look at the technologies, we are very confident in the future. And I think that the future is bright for us, regardless of the direction of the elections.
All right, Gio, thank you for your time today. Really appreciate it.
Thank you very much.
Hope to see you soon. Giordano Albertazzi of Vertiv.
All right, that's hey, very good, very good. So look at this chart.
More energy efficient.
Chart. Look at this. It's on 40%.
Power for data centers.
Oh man, why do they do that? Like, can you guys stop doing? Oh my God, these guys, these CNBC guys are always doing this crap.
Demand is growing.
Okay, let's see. U.S. data center energy demand consumption projections in terawatt hours. Ooh. So right now we're at 178 terawatt hours going to 606. Guess what? Utility stocks. I keep telling you guys, buy them boring utility stocks. It doesn't matter. You'll need energy. Illegal immigration, AI, Bitcoin mining, I don't care. It doesn't matter. Any of those three will make you consume. Inflation is going up. You are going to get overcharged for your electricity, your heating, your cooling, all this stuff. And water. Water demand will go up. You will enjoy. So it doesn't matter if you believe any of these stories. One of them 2 of them or all 3 will happen, and you will just be like milking it because oh, it's such an easy play because utility stocks are so boring right now. Their PE ratios are so low. They don't have good multiples. And what did I tell you last week? Multiple expansion. When those boring utility stocks start acting like tech growth stocks, people will be like, huh? What? Why did I buy that trash? I thought it was a boring stock. Phew, man. Who would have thought? Who would have thought? Ooh. Ton of them. Yes, they're more to be seen. And like VRT, this company is Vertiv or whatever. Let me see. Let me look at the dang thing. Yeah, Vertiv Holdings. So this one, right? There's a lot of companies that do support work, and we covered another one of these. So VRT was one of them, and another Tropes, I believe, mentioned another one, which has a very nice looking chart. VST. So VRT and VST, how easy it to remember. And VST has more of the nuclear things. So VST, VRT, look. So these 2 companies have very nice looking chart. Any type of companies that have support work on building infrastructure will also benefit. So you got the utility companies, you got the support utility company type companies, anything like that. Excellent. All righty. So there was another chart CNBC just flashed before your eyes before, like this ADD generation, like they just show you all this like
You are
most
headquartered, I
like
understand,
this
in
one.
Westerville.
Okay, this is really important. Really important. So this is probably was ripped off of some MBA's thesis at some consulting company, probably Boston Consulting Group, Bay, what's the other one? Oh man, what's the other? It was like there's so many other consulting groups. I keep forgetting their names, but they always come up with these charts, try to hype people up and buy stock and things like that. And Benjamin Netanyahu used to work for I think Boston Consulting Group. Consulting Group. So anyhow, yeah, look at that. Let's see. We got HVAC and physical infrastructure in the orange there. You got the blue, other DC hardware, so direct current, and you have server and storage. Okay, perfect. So all this stuff, we are moving up to a $600 billion CapEx, so capital expenditures. Very nice. And so that's why I'm going to show you something else. So we can look at VST, right? One of them that Tropes mentioned. VST right here. And then VRT was the company that was just shown here. VRT, very nice looking chart. And they talked about SPAC. So if you guys don't know what a SPAC is, that was one of the ways to get into the IPO market that was very popular in the 2021s because the liquidity was so good then that they didn't need to go to private investors. So they could go directly to the public using a SPAC vehicle, but most of those companies went to crap. I remember there were a lot of them, man, there was this medical insurance company. Yeah, most of them did not work out well, I think. But yes, this chart is very nice because you can see this base building up here in 2022, and then you saw a lot of volume come through here during these 2 sections, probably through earnings, right? So once the whole interest rate thing cooled off, 2022 it had to die a bit, but from there, yeah, it made a nice base, and once it broke out of this huge drop in February 2022, yeah, so once it cleared this last hurdle, yeah, this is a nice chart. This is really good, really nice. See this huge break here from that level in 2021. Oh yeah, that was complete. Once you got that, I probably should do a point and figure chart to show you guys how, if you just looked at this structure here, you could. This is very Wyckoffian, right? So you look at your homework, you do your Wyckoff study, you look at this pattern here, this perfect accumulation, and then you could make a point and figure chart. You probably would be like, okay, if I break out My price target will probably be around here, and then a secondary price target probably up here. If you took this whole structure as itself, well, the first structure will be this part, this whole full structure will be that part, and you probably would have predicted that it could potentially reach 109. So this is probably the end of this phase, and once you go here, you're gonna go sideways again, I think, from this point on. So yeah, I wouldn't be buying this dang stock. It's too late because most of the build out for data centers and AI was already done at this juncture here, up to leading from 2023 into 2025. From this point on, it's going to be the software companies, not the hardware or hardware support companies, that will take over the cycle. And I'll show you, like, so cyclical, secular, right? So that CEO might talk like this is a secular story, like his company will always benefit, but that might not be true. And you would rather be in the software companies from here on out. So any software companies that deal with AI will be making the money from this point on. These guys can't grow no more. So if they can't grow anymore, how would they expect stock prices to move up? The only way it would move up now is as if people keep thinking it can keep growing. If it has a stall point where it can't grow for a couple quarters, they'll be thinking like, oh, this thing can't grow anymore, so we're jumping out. We'd rather be in some stock that can grow, because the software guys will be making the money from this point. So this brings me to optical interfaces. So this is probably the most important thing in a data center. So when you see spending, you will have cables going between the racks, and these are generally optical fiber, specialized optical fiber, and Coherent is one of them. This is Stanley Druckenmiller's one of his long picks right here. So I'm going to look at other stocks, a COHR. So this is Coherent. Now I'm going to look at other stocks in this sector and see what you guys think. If I look at Lumentum, the same in the same sector. We have AAOI, same sector. SMTC, around the same sector. MTSI, it has part of its company in that sector, but a part of its company is in industrial, defense, and other things. So it doesn't have the same shape. Fabrinet, same issue, right? It's more straight here. It's linearly going up. But if you look at AAOI, SMTC, Light, Lumentum, like all these ones, they haven't gone anywhere. And the reason why is because I keep telling you, some companies are very cyclical and some companies might tend to be more secular. What this is telling me is that some companies are benefiting more from temporary growth in spending for data centers. So this one here, like, look at Lumentum from 2018 to 2020, there was a huge burst of spending for cables and whatnot into data centers by Facebook, Google, Apple, anybody with data centers, right? But after that, they stopped spending because they built out enough to hit capacity. So they're not going to buy again until like the users will start increasing. Now this new AI stuff will increase like more users, right? More services rendered. So more data centers will be required to process. So therefore, we might be another era where this stock will move up temporarily back up here. And then once they build out for the next stage of AI and all that, they're done building, it'll go down. So when you look at a stock with very little history, like Vertiv, like this one, what history does it have? It's only started trading in 2020. We don't know what happened before, right? And then you look at the stocks that have traded before, you see like, oh, it went up and then it went down, it went up. So we don't know, like this could be at a top of its cycle and go down. So that's what I'm saying. You got to pick stocks that have a secular growth story if you want to be an investor. If you're just trading or just investing for a period of a couple years, this stock is fine, perfectly fine. But don't expect to be holding it any longer than that, because this might be the top of its cycle. And then what you want to look at are software companies. So they haven't started their cycle yet. So like RXRX, software companies where like this thing uses AI to generate drug to manufacture, like design drugs. This is what this does. And then you have SoundCloud, and the SoundHood, I mean. So this is another AI software company that's invested by NVIDIA, RXRX. and sound SOUN. So yes, you should be looking in other things right now. So hardware might not be the play to be. These companies might have reached their peaks already. And so that's why when I talk about business cycles and things like that, I talk about bonds, commodities, also individual sectors have their cycles too. And if you know that, you can time it. That's it. That's the game. And you have to know where the trough and the tops are. And that's all you got to do. There you go. No, I never heard of any of these blacks. I don't play around with that stuff too much right now. I mean, I would have to go through all their charts, look at where things are, look at their sectors, see what the cycle is, and see if it's timed correctly, and then from there we move in, because that's all I look at is cycles. I don't look at fundamentals, nothing. I just want to see the cycles. That's it. If I see this sector and the stock within that sector, the best one, and then if I see the cycles line up, then I'll trade it. If I don't, I won't get into it. That's about it. Because otherwise you get stuck in areas where you go nowhere for a year or 2 years, like Tesla, right? I mean, that was the end of its cycle. 2021 was the end, and it's going sideways now. Now it's probably going to start the next leg up, right? So that's everything is all cycles, and you don't want to waste your time and leave money in an area that's dead, like here. That money could have just went into Nvidia and just went up. So the time that it's going flat, you would be in stock that's going up. That's the whole game. You are rotating. So yesterday I was talking about sector rotation with that video. So like you see, there's rotation, but he was talking about stocks to gold, gold to stocks. Here I'm talking about within stocks. So different sectors of stocks, and you keep moving from one to the other every quarter, every year, depending. Some cycles work faster than others. I don't know, but that's what you have to study. And when you study them more and more, you can do that. But yeah, I'm personally, I'm just lazy. I'm not going to look at so many stocks and so many things, but I feel like when you do this well and you can automate most of this work, because charts are just something that you look at visually, and AI can do visual work very easily. That's how you do it. And that's why now with the AI revolution, AI can easily just do this for you. It could just look at patterns, see the structure, say, go like, oh, okay, I see this pattern, I see that pattern, I see the cycle, and then analyze hundreds of stocks, thousands of stocks all at once for you. And then this is where the future will be going towards. And then once you understand that, oh damn, you're done. You can beat anybody. Because most of the quant guys are so focused. Like you saw yesterday, I gave an example of quants, what they would do. They would analyze the options market. They would say like, okay, this week, the third week of every month has a point something % higher chance of doing this than not. So therefore I would trade this way. Like, bruh, I mean, I don't have billions of dollars where I care about 0.5% like advantage for like the third week of it. I need big gains, man. So for people like us with small capital, we're trying to hit these big multiples where you just hit the targets very well. You know that this is a start of a big cycle, and you just want to capture that all, because I'm not going to spend my time like trading every week and using algorithm. Oh my God, you're putting a lot of effort. And you have a lot of tax issues with that too for some people, where if you're over trading and you're just like, oh man, just for a small % of gains, and now your tax forms are like these huge these huge libraries that you have to send to the IRS. It's like, what's the point of this? All you're doing is making trouble for yourself. It's just like, bro, the amount of effort for just minuscule gains for people with small amounts of capital is just ridiculous. So I I rather not waste my time with that. That's what I'm just trying to make for you guys. So the argument for you guys to try to stick with just charts and not go into the weeds. Yeah, because we're not PhD mathematicians here. I'm not gonna optimize a curve to get like 0.1% over some other guy. That's such a, the rewards are so little at that point. It's diminishing returns. So this is what the key is. This is the game. And I think with AI and and the stuff I'm seeing, oh man, wow, look at this gold stock. See, I warned people. Oh, see, this is exactly it. So man, I was gonna leave this till later, but here, you see this? You see this chart right here? So this was the gold miner ETF. Guess what? Right? It pokes its head right out right here, and this has all the gold miners, and NEM is one of the big ones, and it had its earnings. Oh, it's dropping, and I bet people are screaming and yelling and going like, "Gold is going up. Why? Why? Blah blah blah." Miners, see, if you just look at a dang chart, you're going up to the top and into earnings. If it's gonna go through it more, it better beat earnings like crazy. It's hard to beat. It's gonna be hard to beat. So that's the problem. This is Newmont Mining, NEM. I believe they said their costs are going up because of some issue with some maintenance they have to do in Papua New Guinea. Like, whatever. I mean, I don't care. I mean, all I do is I just look at the chart and go like, well, the risk reward is no longer good. I would probably sell that ETF and then wait for confirmation. So it might confirm. Like, it might not drop much lower. It might just drop here and I'll just buy it again. No problem to me. But like the other thing is Silver Miner, EXK. Yeah, see, I was selling Monday, Thursday, but it's holding up. Silver Miner is still holding up well, so it's not being affected by Newmont's earnings much. At least that one. This kind of looks a little bad for silver here if it's doing this, but I don't know. Let me pull up this chart. So that's Silver Miner. Yeah, I don't know. I think I had another chart. Let me see, silver. Yeah, see, it's hit the cyan line. Let me zoom out here. Yeah, I drew that way back when, right here, February 12th, right? Well, I didn't drew it way back when. I just drew it like maybe a week ago when I saw it break the once you break that green, yeah, you're going like, well, what's the next resistance? Well, look at the past. It was here. Those two in 2012, those two areas were trouble. So now it's trouble again. Yeah. That's it. That's pretty easy. It's not telling me like anything about prediction. I'm not saying like it couldn't have went through it. I'm just saying like it wasn't likely. So I would just hedge or take some positions off, right? No big deal. I mean, yeah, no big deal doing that. You can always buy it again. Anyhow, let's look at Tesla. Ooh, man. Oh, yes, that's a nice candle. So from this point here, if Tesla can get over 261.8 around this area. So if I pull this pink line over here, this point here, it's the same. So I think this last move from April 2023 to June 2023, this is the last big one, and then another repeat of that action from April 2024 into July 2024. It's a repeat. You see, it just keeps hitting this area. Now, what you want to see, because if this is a big confluence here, if this is just a big range, we can go here, start testing, and then break out. Once it breaks out, I will have to do a point figure chart because this is a huge range from 2020 into 2024. So I think when you combine all this area together, that means the price target can be quite big. So maybe it'll go up to $600 or $1,000 a share or something at that point. So if you want to get in, I would wait to see how it does here, and then when it's ready, it's just going to shoot up. So most people that trade, yeah, they probably wouldn't waste time buying these bottoms here. They just wait for when it gets back to the top of the range and then bust out. And that's why the Chinese stock, similar one, BYD, right? This one I mentioned, and yeah, I mentioned this before. Yeah, BYDY. Yep. Okay. Let me go to the other chart. Oh man. Okay. So this one, this thing. Yeah, and right around July or June. Yeah, Ryan asked me why I thought it would just go up. So it's just simple. You just look at the volume here. It's huge, and it didn't go any more down. It just kept going up after that, and you just keep seeing it pump, pump up. When you see that, you're probably saying like this is most likely the last big buy. So whoever bought down here, investor, whatever institutional investor bought down here, this is 4 million shares traded, was like, well, I think this is the last time it's going to go to the bottom of this range. That's what I'm guessing. I'm just hypothesizing. And then when you take into account this whole area, that means, and we finally got to the top here. Now you're waiting to see if it's just going to roll around, and then into next year, break out. So once BYDDY breaks out 85, so this Chinese car maker breaks out, that means this huge area of accumulation means that there's a lot of room to grow. So this is a base. And there's a saying, the longer the base, the bigger the base, the higher the space. So this thing will go up. And when you look at Tesla, it mirrors it. See? See that? It goes sideways for the same amount of time. Why? Because Tesla's growth is required on dependent on China at this point. And Tesla has more than just China, right? It has this robo-taxi, it's other stuff that it wants to do AI. So I'm just saying. But right now, the primary reason why it's in this range is because there's no growth in China for Tesla or BYD, because the Chinese government, only recently instilled stimulus because it was locked down the longest. The consumer, the middle class of China doesn't want to buy, even though it's the largest growing middle class in the world outside of India. So if you want growth, if you want mega growth, and I told yesterday, Tim Cook visited China again. How many times Tim Cook has to visit China? He has to suck China's dick if it wants growth, because Apple's growth is dependent on China. So that's about it, man. That's really about it. Everything's about China. So if Apple wants to break out of this thing, yeah, you need China. Beat China, China, China. That's it. Okay, so yeah, and now BYD can't be swearing off of EV because that's government mandated from China. So BYD is Chinese government. I mean, Chinese company is going to listen to what China says. So if China wants EVs, they'll keep doing EVs. That's the end of that. So that's the requirement from the government. That's what you get when you have a technocracy type situation there. Anyway, good. So if you look at those charts, look at them together and see how it goes. And I don't think I need to explain anything else outside of that. I think I want to look at Boeing. Yeah, let's look at Boeing. That's what I want to look at, Boeing. Yeah, okay, see. So that's it's going down there. So we'll see. Have to see if it drops to the bottom of this range. I don't know. I don't know how much more bad news we could have. But yeah, look for 140. See if that's the next area of Boeing. We'll see how that goes. And now let's go back to videos. I got plenty more videos about EVs. I mean, not EVs. I mean AI, because everybody loves AI, don't they? AI, next one. Okay, this is from some professor who just got a Nobel Prize. Okay, if you believe a Nobel Prize winner, a Nobel laureate economist, here we go.
Welcome back. How will AI impact our economy? Our next guest has said some short-term estimates of it having a big impact are overblown. We talked about that on this program a little while ago. But in a New York Times op-ed last week, he named it as one of the 3 factors driving the coming economic storm, which he also says America is unprepared for. Oh, and he just won the Nobel Prize in economics along with 2 other researchers. That was for his research on economic development and institutions. Joining me now is MIT economist and Nobel laureate Daron Acemoglu. Welcome back and congratulations.
Thank you. It's my pleasure to be with you.
What are you going to do with the prize money?
Oh, I'll find a way to spend it. The U.S. economy needs all the stimulus it can get, so I'll use it.
Why are you so downbeat? I should have had a copy of The Economist. It shows America's kind of like this rocket ship. It's this island of prosperity in a world. You probably read the Draghi report about Europe.
Yeah.
But what do you see that everybody else is missing about why our good times could dissipate?
Well, first of all, I don't think we've had such amazing good times. If you look at the measure of productivity growth that economists focus on, it's been pretty slow for the last 20 years. If you look at real wages, there's some movement over the last 5 or 6 years. But, since 1980, about half of the US has had pretty anemic wage growth. So it's not amazing times. Now, I think there is an opportunity for us. And the economic storm is really both a challenge and an opportunity. I talk about AI, I talk about aging, I talk about the remaking of globalization. All of these things are threats because they are big changes, but they're also opportunities that we could use in order to make ourselves more productive, workers earn more, in fact, even reduce inequality.
Sure.
But the problem is that we're not prepared for it.
So I will say that it would be awful of us to celebrate or champion an American economy that was the fruits of efforts planted decades ago that we are no longer planting. And if conditions have changed and are going to lead to a different, well, it's incumbent on us to recognize that they've changed and try to improve that so that 30 or 40 years from now, another economist article can be talking about how great America is doing. Here are the factors that you think are problematic. Number one, aging workforce, fertility decline. Number two, automation and AI. And number three, changes to globalization. Are these reversible, and how do they come together to create a problem? A lot of people say AI solves the demographic issue.
I think they do interact, and AI could help solve the demographic issue. Robots can help solve the demographic issue, but the demographic issue is a very big one. It's not reversible. More immigration, especially new, younger people coming in, could slow it down. But the whole world is in the middle of a demographic transition, and the U.S. used to be a very young economy, and that contributes to entrepreneurship, risk-taking, a lot of demand. That's not going to be the case anymore. So that's something that's going to hit us, and we are not getting prepared for it in terms of changing jobs, making jobs better, more easier for older people to perform, and also investing in people so that they can do different tasks and work alongside robots that we will need to use more. AI, I don't think that's reversible either. There's a lot of investment in AI. This direction is to be determined. I think we can steer it in different directions, and some of it may be better than others. Globalization, I think that may be reversible. I'm not sure, but I think they're coming.
Yeah. So it's interesting. Well, I mean, a lot of people would say fertility is reversible, but the one I really want to talk about actually is work from home. So going back to the point about keeping every possible person in the workforce, I understand why companies want to bring people back to the office who have been set up that way and been successful that way. That's fine. But I hope that overall there's still a lot of options for remote work to continue, because anecdotally, that's where I hear many, many people who had been disassociated from the workforce able to come in, stay in, maybe work a little while caring for people who are older or younger than them. So I'd hate to see that, kind of be a relic of COVID.
Absolutely. I think you are absolutely right. Working from home is going to be an important element of our workforce policies, and I don't think we want to give it up. On the other hand, I think we are just coming to grips with what does it mean, for example, to form teams so that people work together, they learn on the job. A lot of investing in people is about on-the-job training. How do we do that when people work from home? I think there are some questions for us to tackle. Technology will have to play a role, but I think the most important thing that I tried to emphasize in that New York Times article is that we need to invest more in people, in the American worker, than we are doing at the moment.
All right. I don't want to kind of leave this on too overtly political of a note, but you are also concerned or endorsing Harris and her economic policies. We're seeing bond yields right now kind of rising sharply on the long end. Some say there's a political reason for that. Others say not so much. Do you want to just kind of leave with a parting thought on what's happening with the U.S. economy right now in this very moment?
Well, I mean, I think the U.S. economy right now appears relatively resilient, much more so than it did several years ago. And I think one of the reasons why I like the Harris economic plan better, because it has more in terms of worker training and thinking about ahead of the curve about AI. I think, for example, across the board tariffs or, big tax cuts are not what we need right now, because we need a lot of resources to invest in the American worker.
Okay, understood. Although you could say that both Harris and Trump have very similar kind of deglobalization kind of policies.
That's right. The devil's in the detail. We'll see.
All right. Daron, congratulations again on the Nobel Prize. I'd be curious how you spend it, at some point. If you did, none of my business. But
well, I'll share it. I'll share it.
All right. Okay. Yeah. So you got your ivory tower opinion for the day, And I think you got to listen to the last point about that they did not cover deglobalization, which will be the big driver of inflation, which we will get to in 2 videos, I think. So let's see. Oh, okay. BYD. I meant a Geely Holding Group. Okay, I'll look that up. So I'll look up all the tickers you talked about, Blacks. So yeah, I put them on the to-do list here. Anyway, let's go to the next video. Let's go to the next video here. ServiceNow. So they had earnings 2 days ago. So let's get hyped. Let's drink some more Kool-Aid.
All right, Bill. I mean, you are the greatest salesman. We know that, and you've made the case here. I want to come to you on macro a little bit. You know, you always get questions on the conference call as well. You're obviously telling our viewers how your various products are being used in the enterprise. What's your sense, though, overall, in terms of generative AI and how it is at this point, and what's coming in terms of how the enterprise, you know, how it's going to be penetrating the enterprise in a productive way?
Everything is going to be AI driven. In the next 2 years, every single enterprise in every industry will reinvent every workflow around every persona or job in a company. So the people that are deniers on AI, they're going to lose big. So we leaned into it more than 5 years ago, building Gen AI, large language models, and domain-specific multimodal models on our platform, which just simply means when you run an AI use case on ServiceNow, it's domain-specific, which means we built it into the platform. It has 0 latency, which means it's rocket fast, and it's totally secure. But best of all, it's really cheap to run. And that's been the missing element in the enterprise. No one's brought enterprise Gen AI to the customer in an affordable way, where they can literally forget about offshoring labor, take all the labor arbitrage and do it right here, whether it's in the United States or Europe, somewhere else in the world, because the platform can now do the work. And that's been something that's missing, and we filled that gap. One other thing, you have to integrate with everybody else's language models. So there's great companies out there like Microsoft and Google and Amazon and Meta, and they have great models. We integrate with all of them seamlessly. So bring your own model, work with other great companies like that. But in the end, as Jensen Huang would say at NVIDIA, ServiceNow is the AI operating system for the enterprise. This will be the central nervous system for how best run businesses run.
But how's your strategy around AI agents, which is what everyone's talking about, differentiated from a Microsoft or a Salesforce, which are in a little bit of a beef right now about agents?
Great question. If you think about the problem in the enterprise, the 20th century enterprise is a state of chaos. There is 50 years of legacy systems that were built to serve each department, sales, finance, HR, accounting, etc. What we did is we built a platform that spans all of those departments, where you could integrate business operations seamlessly with a great user experience. So today, 17 different user experiences per employee, eating up 33% of their productivity. The enterprise is a disaster. We took one clean pane of glass, put it above the mess, and made everything productive. Now let's go to the Gen AI agents. People will put out their Gen AI agents departmentally because they build departmental solutions, which is actually going to cause even more chaos. It's like hitting a hornet's nest with a bat. These agents are going to run wild. With ServiceNow, not only do we have our own agents, but we integrate with everybody else's agents. So humans and AI agents can be in a workflow working together. And we control the governance, the compliance, and the risk of managing those agents so things don't get out of control. Working together. And we control the governance, the compliance, and the risk of managing those agents so things don't get out of control. That is another competitive advantage for ServiceNow.
Man, I don't know. Why does that guy sound like a insurance salesman? Jesus Christ. Anyway. All right. Okay. Are you hyped yet? Are you hyped yet? Now, this will get you real hyped. Right out of NVIDIA's mouth.
In order to lead in artificial intelligence, you need to have AI model technology that India has. You need to have data, massive quantities of data. And using the last thing you need is AI infrastructure. And we're announcing that Reliance and NVIDIA are partnering to build AI infrastructure here in India.
Absolutely.
And then the thing that I will say is that in order ultimately to create that into a flywheel is one of the great advantages that India has, which is a very large population of users. And so now you have the fundamental ingredients, AI, data, and AI infrastructure, and you have a large population of users that ultimately creates your AI flywheel. The thing that I really love, and when I met Modi ji, the first time he asked me to meet his cabinet was this has got to be about 6 years ago. He asked me to address his cabinet about artificial intelligence. And I was so surprised. It was literally the first time any government leader, any national leaders asked me to address his cabinet on this particular topic. It was long before anybody was talking about artificial intelligence. And my last visit with him, he said this, and it was really quite profound. He said, I was explaining to him the concept of AI infrastructure and why it's essential for every nation to have their own AI infrastructure, like their own communication, their internet infrastructure, their roads, like energy, of course, and of course, intelligence should be part of your infrastructure, and the manufacturing of intelligence should be part of your infrastructure. And he said this, he said, it makes complete sense that India should manufacture its own AI, manufacture your own AI. You should not outsource, you should not export data to import intelligence.
Okay, listen to that again.
You should not export data to import intelligence.
All right. So that key phrase there, you should not export data to import intelligence. This is inflationary. Like, I read articles already, maybe a couple weeks back, talking about Dubai, Saudi Arabia, all these countries hurrying up to build their own data centers. So the reason why there would be large growth around the world for AI equipment is because everybody's replicating the same stuff. They want to do the same things within their own borders. And when you compound that with the mining issue where, oh, we want to mine our own lithium, we want to mine our own nickel, our own lead, our own commodities. So data is being commodified, right? Intelligence is being commodified. So everything together is commodified. And that's going to lead to a big surge of inflation because nobody now wants to give another country access to things because they want to make it cheaper. It's over. So the era that I grew up in, where it was so easy to make money in the stock market and all these things, because all I needed to do was buy AMD very cheap, Tesla very cheap, and got money from it. And I lived in an era where there was low inflation, right? Rent was cheap, everything was cheaper. That's over for the next generation. It's over. Everybody now is putting themselves into silos, building their own, replicating their own things, repeating their own things. So companies like this, NVIDIA, TSMC, that have the secret sauce to make all the AI happen, they can charge an arm and a leg for it. And what article did I read yesterday about the fact that we are in a Malthusian era here? We are entering, okay, I didn't go over that all in depth, but you got to tie all these things together yourself. And so that's why gold, when you saw like yesterday like the chart where they were predicting maybe it goes to $12,000 an ounce, that might happen. you might actually have $12,000 an ounce gold. All right.
That India should not export data to import intelligence. And he said,
Absolutely.
and Modi ji said, it's like India should not just export flour to import bread. We should add value to the data ourselves. And the partnership that we have is to start that journey, to build the underlying infrastructure so that India could have your own infrastructure. You surely have your own computer science expertise. And you also have your data. You have a giant population of users to drive that flywheel.
Okay, let's go back to the charts a little bit here. Let's see what we got. See what we got. It's almost 14 minutes until 11 a.m. my time, Pacific. And let's look at how things are doing. So we pulled back in the semiconductors. Now we're going back up again. So I think we're in preparation for next week's move. NASDAQ, okay, it recovered. So nothing new there. I think it's about to break out of here. So I think, yeah, we're looking very bullish going into next week's earnings. I see no issue. Okay, let me look. Do I have any stock tickers to go through that seem important? Lithium, I don't think was doing anything. I don't think it was doing anything here. Lithium. Oh yeah, Bitcoin. Yeah, I need to cover Bitcoin. Yes. All right. I gotta cover Bitcoin. Okay. This looks nice. Beautiful looking chart. Oh yeah. Yeah, this looks good. Very nice. Let's look at the 4-hour. Yeah, this looks really good. I think it can hit 72 by Halloween. So we have Bitcoin stocks, MSTR, Michael Saylor's baby here. It's hitting the tops. It went through its top like at 198, about 198. It's still hanging above there. And my favorite miners, I'm looking at mining stocks. So I was buying at the bottom of this range a little bit. I was just kind of like doing it a little bit. So Mara, M-A-R-A, Bitcoin mining, 14.5 and lower. That's the area to buy. And now it's the top of this range, 18.5. See, as it was set way back when in August 2022 and July 2023. So this area is and August 2024. See, so this area is quite important. Once it breaks out, it can go back up to 30, and then from there, when Bitcoin is ready to move, it'll just do a multi-bagger. And if you do options on that, yeah, you're gonna make big amounts of money if you time it right. CLSK, another CleanSpark, Bitcoin miner. So it dropped to its lowest area at close to $8 here a share, and now it's back up to 12. So this was set back in August 2020 and August 2019. Okay. So once we go over there, then we can re-attack the 20s up here. So going from 12 to 20s. And then once Bitcoin is ready to move back up, and I think I'll have to go back and do another point and figure chart analysis on that to find out what the price target will be for Bitcoin. But yes, once you get there, yes, we're ready to go. So hold on to your hats. See if this thing will hold 10.50 for CLSK and for Mara. See if this one holds. Probably it just needs to stay above the 50% of this range. So maybe 16-ish, 16.5 if it can stay above there for the next couple weeks when we go into elections, if it's good. Because what I expect is the Bitcoin will hit 72, pull back one more time, Yeah, well, it'll try to hit 72. Let me go to this chart here. Yeah, this area here. We're still in this cyan area. And we had a big fight in July, and that's when it failed. And now we're back up here. So yes, once it hits 72 again, and then keeps holding around 65 into Thanksgiving. I think once we hit Thanksgiving, that's where things will really pop off. Depending, but if Jerome Powell says really sweet things after the elections, 2 days after the elections, and the elections have been counted, all the ballots, mail-in ballots have been counted in time, because I don't know, it might last 4 days before we find out who the heck is our president, and that might really spook the markets when they don't know who actually won for a few days after. Then yes, you'll see something. So keep your money tight. You can keep adding. So if you're long Bitcoin, get ready to add, because things are going to explode. Because this range, yes, we will see a big move into Q1. And that's when all the shit coins will start moving up. Around January to February, you'll see a lot of Shibu, Emu, whatever, blah, blah, pregnant butt. I don't know, what's the other Dogecoin? What's the other trash ones? Yeah. But Solana is probably the one I would be looking at. Solana. But I'm not a crypto guy, so I haven't looked at all of them. But I'm gonna have to do my homework, because which ones will be most likely to zoom up the most, the best? Yeah, I'll have to look into. So that's my homework. Okay, let's continue on to the videos. Let's see. What's my next one? Oh, this one's a long one. I don't know if we can get through all of it, but it's probably important. I haven't watched it myself, so I'm just going to watch it with you guys. So this is the ARM CEO. Talking to Bloomberg.
To have you, and thank you all for joining us. We have a lot of questions for you, so we'll go ahead and get started. First, I'd begin. You are not just the CEO of ARM. You're now a podcaster. Also,
That's right.
You began in your spare time, I guess. You began a new podcast. It's called Tech Unheard, and your first interview was with Jensen Huang.
That's right.
Which I gave a listen to. First of all, what gave you the idea to start a podcast? And secondly, how do you find the time as CEO to do something like that too?
Yeah, so first off, thank you again for having me here. I'm an amateur at this, so you don't have to worry about your day job as far as podcasting goes. We were talking with some of our board members about how to use a unique medium to talk to leaders, talk about the ARM story. And one of the ideas that was suggested was a podcast. I was a radio disc jockey, actually spinning records in university, so I had a little bit of experience and aspirations to do that kind of work early in my life. So in talking with some folks, around the team, we said, let's try this and let's do something a little bit more innovative and talk to other leaders and give them a perspective of maybe a conversation that they may not naturally have with someone who's professional like you are. So yeah, we kicked it off. Please listen. It's on Apple Music, Spotify, and Jensen was my first guest.
Great. Congratulations.
Thank you.
Now, in terms of the business, ARM was acquired by SoftBank for about $32 billion. At some point, SoftBank agreed to sell it for about $40 billion. That deal didn't go through, of course. NVIDIA was supposed to buy it. That deal didn't go through. Now, you went public just over a year ago. Company's worth roughly $160 billion. Which seems like a successful IPO. But could you talk to us about what the business model for ARM has been and how it's evolved over time, over that period of time, and especially what's the strategy going forward?
Yeah, well, thank you for the the nice words. 30-year-old plus company. Our business model for most of our time on Earth, if you will, was very horizontal in that we had a licensing model, we developed IP, our products are primarily CPUs. The business model was very horizontal in nature, meaning that we designed a very general purpose product, very power efficient product, and then licensed it to customers independent of the vertical market. In other words, we didn't really target a certain vertical. I took over the core IP business right after SoftBank bought ARM, and we pivoted to a more of a vertical approach, meaning that we now have products very specific for the data center, very specific for automotive, very specific for IoT, smartphones where we were born. And that diversification really allowed us to expand into many new markets with brand new products. SoftBank buying ARM in 2016 allowed us to invest in those new areas. So fast forward, the result, what you're seeing now in terms of performance, is that strategy, going forward. As we think about the next number of years, what we're seeing in the marketplace is a need for more solutions. Chips are getting increasingly more difficult to build. It takes a long time to design a chip. It takes even longer to fabricate the chip. So the more that ARM can do to help customers get to market faster is helpful. So we're now developing solutions, what we call CSSs, that get people to market sooner and allow them to get more profitably in a sooner way.
Okay. I want to talk about AI, and in particular the opportunities in AI. There is some debate, as we've referred to, I think, in a couple of these sessions, about whether there's a bubble in AI. I'm going to assume that you think that there are real opportunities there, but can you talk about what ARM's role is there and how you see the company evolving to take advantage of those opportunities?
So one of the most unique things about our company is the fact that the device that we build, the CPU, we estimate that 70% of the world's population touches ARM in some way. We're in security cameras, automobiles, PCs, smartphones, data center. And what that means is every workload, whether it's an application, an operating system, or AI, runs through ARM in some way. So that means AI is going to run on ARM, period. And we're the only company on the planet that can run those AI workloads from the smallest devices on the edge, again, a wearable, glasses, watch, phone, to the data center. So for us, AI is a gigantic opportunity in terms of growth going forward because AI is going to be everywhere. And as far as a bubble goes, I just don't ascribe to that. I look at things such as, well, people say, gosh, is it overhyped? Or the stocks have gone down last quarter. That's almost like saying, should I short AT&T in 2000 because the internet's not going to happen? Or if Ford was a stock in 1907, would I short them because the automobile's not going to happen? It's just not. I mean, AI is, we've seen such advancement across AI in the last couple of years that the amount of innovation that it's going to drive is just going to be incredible.
Okay. The chip company that probably has taken the most opportunity, or has been able to capitalize the most on AI so far, is NVIDIA, chip maker in your space. They now have a near monopoly in terms of the highest end AI accelerators. How do you see that evolving in the future? And are there opportunities for ARM in particular to be able to play in that space and derive real revenue from?
So we're there already. NVIDIA's most advanced chip, called the GB200, which is Grace Blackwell. Microsoft just announced that they're going to be deploying Grace Blackwell, the most advanced NVIDIA chip, in their data centers. That uses the ARM CPU. So Grace is the ARM CPU. Blackwell is the NVIDIA GPU. So ARM is there already. So we are going to play in the most advanced data centers using AI. ARM will be there. I think what's most exciting for us, as I mentioned, though, is the fact that not only will we be in the data center for training these algorithms, ultimately the training has to be transferred into inference. And training is the teacher, inference is the student, inference is actually running the workload, and inference, actually running that AI agent, that's going to happen in the data center, that's going to happen in the car, that's going to happen on your watch, that's going to happen in glasses, that's going to happen in phones. And everywhere it happens, it's going to run on ARM. So it's going to be a gigantic opportunity for us. The data center is just one place.
Okay, so you see ARM having opportunities kind of from the beginning to the end of the...
More than opportunities. The agents will run locally. And the reason for that is you'll have a hybrid situation where some of it will run in the cloud, some of it will run in your local device, again, your glasses, your wearable, your phone. But locally, what you'll be able to add is security, things that can make sure it's private to you, that not all your data is being passed to the cloud, and vice versa. So yeah, for ARM, I think it's going to be just an amazingly large opportunity.
Okay. As we were talking about before, I just moved from Japan, where we spent a lot of time looking at SoftBank and especially Masayoshi Son's ambitions. We've written stories about how SoftBank is looking at ways to enter the AI chip market and particularly to compete with NVIDIA quite directly in GPUs. He has a secret plan, Izanagi, that we've written about in the past. How does ARM, isn't still 90% owned by SoftBank, how does ARM fit into that equation?
Yeah, so no product launch announcements today. So nothing I can say about products coming out that you've written about. I can say that I'm a SoftBank board member. I do advisory work for SoftBank. I talk to Masa all the time. It's no secret that he is a big believer in AI, has been for quite some time. He's talked about it actually probably as long as any of the folks out there. I think his vision in terms of where it's all coming together, now you can start to see the pieces of it. As I just described, where does ARM fit? All those AI workloads are going to run on ARM somewhere, somehow. So that's the reason that we spend a lot of time talking to SoftBank about the future.
Okay. Earlier, we had the ASML CEO on, and he was talking about some of the challenges that they're facing in the market. They surprised investors last week, as we talked about. And it does seem that there's a little bit of a disconnect in the market where many people see opportunities. ASML reported that their orders were about half what analysts had thought they were going to be. It seems there are certain areas of the chip industry that are struggling quite a bit. And on the other end, you have Sam Altman talking about how we need more capacity in the chip industry. We need billions of dollars, maybe trillions of dollars of investment. What is the disconnect, and how does that get resolved?
Yeah, so there's a lot to unpack there. Where ARM plays, as I mentioned, because 70% of the world's population uses ARM, and I think 300 billion chips have shipped since we were started that have ARM inside, and every year about 30 billion chips. We have a unique view into the industry because just about every digital device uses ARM. There are some markets that aren't accelerating as fast as others, and candidly, those are the ones that aren't using AI in a very large way. But in areas that can use AI and will use AI, people can't go fast enough. And I'll give you an example. Many of the hardware devices that are being introduced today were designed 2 or 3 years ago. That means the chips were designed 2 or 3 years ago, the chips that are going in your phones, your wearables. Those were all invented before ChatGPT was released or before Llama was released. So what we're seeing on one end of the industry is just a rush to develop more and more chips that have this AI capability. Now, it takes time. Chips aren't built overnight. In fact, it takes, from the time we engage a partner, 2 to 3 years at least until that comes to market. So I think you'll see some of these new products coming out. I think what Sam is talking about is just generally the ceiling to get to AGI, artificial general intelligence, requires more compute. And the more compute you have, the better the models get. So I see both. But generally speaking, I'm pretty optimistic about the growth of our industry.
Okay. We were talking about this a bit before. One of the gating factors is making sure that you have chip manufacturers who can make the most advanced chips. TSMC seems to be gaining market share right now as a couple of the key competitors struggle. Intel in particular, and Samsung also has been struggling a bit. They're both trying to move into the foundry business a bit in competition with TSMC. What are the dangers around having TSMC garner so much market share in foundry? And is it good for the industry, or would it be better if there's a more diversified manufacturing base for the industry?
Yeah, TSMC is an amazing company. They've just done so much for the industry relative to the innovation, how they work with partners, et cetera, et cetera. If you remove semiconductor manufacturing or foundry for a moment and just step back and say, is it healthy for any industry to have one dominant supplier and then add on top of that a dominant supplier that's largely concentrated to one part of the world? Not really. So as a result, I think it's necessary, just in terms of diversity of supply base, to have more and more advanced manufacturing and geographic diversity. Fabs in the United States, fabs in Europe, fabs in India, fabs in Saudi Arabia. I think over time, we're going to see not only more suppliers, but geographic diversity as well.
Okay, governments obviously are investing a lot in that very question. You're seeing the United States do it, you're seeing Europe do it, Japan has spent a lot of money on it too. Do you think that's making progress at this point? Do you see light at the end of that tunnel?
It's et cetera.
All right, so you talk about that geographic diversity. So let's go over that section.
If you remove semiconductor manufacturing or foundry for a moment and just step back and say, is it healthy for any industry to have a one dominant supplier and then add on top of that a dominant supplier that's largely concentrated to one part of the world? Not really. So as a result, I think it's necessary, just in terms of diversity of supply base, to have more and more advanced manufacturing, and geographic diversity. Fabs in the United States, fabs in Europe, fabs in India, fabs in Saudi Arabia. I think over time, we're going to see not only more suppliers, but geographic diversity as well.
Okay, governments obviously are investing a lot in that very question. You're seeing the United States do it, you're seeing Europe do it, Japan has spent a lot of money on it too. Do you think that's making progress at this point? Do you see light at the end of that tunnel?
It's the capital expenditures required for these fabs are enormous. TSMC, Intel, Samsung, I think their capex is anywhere between $30 to $35 billion a year in new factories. And if you start looking at the revenues that these companies produce, you start very quickly looking at, oh my gosh, that is a lot of money to invest. Now, on one hand, you can look at it and say, well, the demand will be there, AI, et cetera, but it doesn't take much in terms of a year slowdown in demand, and companies have a really negative financial outcome. So yes, governments have been involved. I think should be involved, is my opinion. We saw in the US for the very first time a policy act around CHIPS Act to put funding into the fabs, which I generally are a big supporter of. I think it's necessary.
Okay. Let's talk a little bit more about Intel and their struggles. You grew up in a chip industry where Intel was really the dominant player.
Yep.
Kind of set the pace for technology evolution over time. Now we're openly talking about whether Intel is going to be broken up, maybe sold into pieces. What kind of opportunities are there for ARM within that space as Intel goes through these struggles?
Yeah, so we work very closely with Intel. It's a bit of strange bedfellows. Many folks would consider ARM and Intel to be natural competitors on the product space. But what's very important to us, back to this discussion around supply base, is that Intel Foundry Services, IFS, is successful. We do a lot of work with Intel, as we do with Samsung and TSMC, to ensure that our products can be manufactured there. We work very closely with their engineers to ensure that the leading edge technology can run on ARM. So we want to see Intel successful, and we want to see IFS successful. I think it might be strange to hear the ARM CEO say that, but we want Intel manufacturing to be successful.
Okay. Bloomberg reported that ARM took a pretty close look at buying a part of Intel. Would you like to comment?
Nothing I can say on that one. Good question, man.
Okay. All right. Thank you. Thank you. I wanted to turn, you talked about ARM moving up the value stack, kind of moving beyond its traditional place in the industry. And as you have moved up the value chain, you've gotten closer to doing what some of your customers do, getting closer to being able to do these complete designs. And yes, it speeds up innovation, as you were alluding to, but it also puts you in closer competition with some of your customers. You have a lawsuit with Qualcomm in particular. Isn't it in both companies' interest to settle that and to resolve the legal dispute at this point? Or what would you say about that?
These are tough questions. It's a good thing I'm a podcaster, so I know what's coming. First thing, on competing with our customers, it's rather complicated, because if you look at some of our customers are Amazon, our customers are Microsoft, our customers are Apple, our customers are Tesla. They all build chips using ARM. I'm not going to build an electric car. I'm not going to build a phone. I'm not going to build a data center. So to look at the value chain relative to who builds chips, relative to whether your end business is a chip business or a product business, it's gotten a lot more gray. We follow what the industry is demanding, and what the industry wants to see is solutions getting to market faster, and that's what we're focused on. Qualcomm, not much I can say on that, other than we're headed to a trial. I think it's the third week in December. We feel very good about our case. We think our case is quite simple and straightforward. And as I said, December we'll find out.
Okay. So you head to the courtroom then. One last question. I think we have time for this. In this audience in particular, there's a lot of interest in whether ARM, which is historically a British company, whether they would ever look at doing some sort of dual listing. Of course, we've heard about this many times in the past. A year ago, when you did your IPO, you decided you would do it in the U.S. instead. What are the opportunities for listing here? What are the pluses and the minuses of that sort of thing?
Yeah, we did. We listed in New York over a year ago, and at that time, our comments were we would look at a secondary listing. We're still open to it. It's not something that's top of mind right now, quite candidly, but we'll continue to have discussions with both stakeholders in the government and the local exchange. Would love to find a way at some point in time, but also at the same time, there's a lot of other things that keep me busy relative to my day job.
All right, so you got a little flavor of the AI. I think that's all for AI today, because I'm going to switch over to natural gas. But before I do, let's look at airlines, because we had American Airlines earnings today. And it looks like it faded all that move. So it was up 3%. Now it's down almost 3%. We also had Southwest. It just went down 6.5%. So not really good. Not really good. So the only earnings that was good for the airlines was United Airlines, which jumped up over 12% after its earnings. And the chart was already looking good into it. So you can see here. Let's see, do the weekly, let's do the monthly. All right, let's just do the monthly. You see that? That's pretty nice. So if you got in United around $37, yeah, you could have got out here at 75. Not bad. That's pretty strong for an airline. And like I said, I do not like airlines because they are a cyclical industry. So they tend to not move anywhere. So if you bought airlines in just before the great financial crisis, you're making money now. You're up 30% from that time. But yeah, I mean, you could have bought anything else and got more money. So I'm not sure what to think about this. Delta didn't do that well because it didn't go up as high as United did on its earnings. And it's now just barely back at what it was before COVID. So strange. I don't know. I don't know what to say. Does that mean like people are traveling more? Is there growth from the domestic carrier point of view? Yeah. Yeah. And I think we're going to have labor issues. I'm going to show one article here. And if we have time, I might go to some other ones. Because I did have some other airlines articles. So I mean, I want to focus on the labor, okay, guys? Because as we said, gold over bonds. If you think labor, like all the strikes happening in Boeing, all this stuff where unions are trying to where we had the port issues in the East Coast, the longshoremen, anything like that where labor fights back, that's inflationary, okay? Doesn't matter where your sympathy lies. I'm just looking at it from a money perspective. The companies will always pass the cost off to you, the consumer. Doesn't matter what it is, you know. So that's why when you see prices go up in the groceries, you know, that's it. They just pass everything on to you. It doesn't matter. You can tax companies to death too. They'll just pass it on to you. Just like you look at your phone bill. How much of that phone bill is just because of taxes at this point? What percentage? Just do your calculations. So yeah, companies don't care. They'll find a way to give the cost to you in the end. So flight attendants union objects to United Airlines stock buyback plans. The Association of Flight Attendants has issued a statement after United Airlines announced a stock buyback following its Q3 results, saying that the move was a huge mistake. Okay, Sarah Nelson, the president of AFA, and Ken Diaz, the president of the United Airlines Master Executive Council, MEC of AFA, issued a joint statement condemning United Airlines' announcement of a stock buyback program on the same day. United Airlines management just made a huge mistake. Stock buybacks were banned in connection with COVID relief, and it allowed airlines to invest in the operation and new contracts. Nelson Diaz added that all employee groups have contracts except the carrier's flight attendants. The pair mentioned the strike by Boeing's machinists, represented by the International Association of Machinists and Aerospace Workers IAM, District Lodge 751 and District W24, saying that the two unions walked off the job because shareholder capitalism nearly destroyed this once great pillar of aviation. United Airlines cabin crew members approved a strike vote, with 99.9% of voters saying yes to the action and 90.21% participating in the ballot on August 28. Then Diaz said that the carrier's flight attendants deserved an industry-leading contract, adding that the strike authorization vote showed the union's members were ready to do whatever it took to get it. I think that's enough. So you guys get the idea. Whatever it is, whatever it will be, just expect inflation to keep rising. So buy some gold, buy some silver, buy some Bitcoin. Yeah, you'll need it. So here's a link to that article here. I'll put this up. So this is a structural issue, I believe. And we'll see if this changes anytime soon, but I doubt it. I think this is a pattern that will keep coming up and coming up. So unless we're going to have those AI Tesla servers working without human intervention, yeah, you got to pay up. You got to pay up. And the CEOs will not take a pay cut. They'll just pass the cost off to you, the consumer. Okay. Yes. So here's the other article I want to read. So this is going back to chips. So you remember the video I stopped and paused at the section where he said, like, it's not good to have concentration in one geographical area. So if you were expecting Europe to take the slack of this and have semiconductors, well, let's see. Wolfspeed and ZF put German chip factory on ice. Wolfspeed has slowed its plans to build a chip factory in Germany. Okay. So the project was not abandoned, but pushed back on the timeline to an indefinite point in time, said Anke Rachlinger, the leader of the western region of Saarland, where the factory was set to be built. Wolfspeed had told officials the group was committed to Saarland, but postponing the investment to an unspecified date, Rudlinger said at a press conference. The delay to the factory, which was intended to break ground next year, comes after another planned investment by chip makers in Germany had been thrown up in the air. U.S. chip giant Intel said in September it would push back a planned project in Germany by around 2 years due to anticipated market demand and was lower than previously thought. The planned factory in the eastern city of Magdeburg, which had been announced to much fanfare, was set to be backed by a huge 10 billion euro, about $10.8 billion, subsidy from the German government. EU countries, including Germany, are seeking to boost the domestic supply of semiconductors to reduce reliance on Asia for the production of the key component used in everything from smartphones to fighter jets. The planned investment in Saarland was smaller, around 2.7 billion euros, but the delay and uncertainty around the project were a blow, Rachlinger said. Wolfspeed and ZF have both faced challenges in recent months, with Rachlinger alluding to weak global demand for electric vehicles and chips in Europe. German auto supplier ZF announced sweeping job cuts earlier this year as it struggles with the switch to electric vehicles and foreign competition. All right. So there you go. Very nice there. And I'll put up the link to that article. I think you got a good idea from that. It's not easy to be Germany. It's not easy. Actually, I do have an extra video here about Germany. Let me play that right now. Might as well. where that is. I wasn't planning on playing this one, but this is a good segue as any. Man, StreamYards is making my computer slower and slower every second. Let's see if I can make it through it. Blah, 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 blah. Where is it? Ah, here it is.
Germany, Europe's largest economy and the world's third largest, is facing economic stagnation due to multiple factors. According to PMI figures, Germany's manufacturing sector, the engine of the European Union's economy, has been in contraction territory since August of 2022, and it's been in a steady downtrend since June of this year. By early October, the PMI had fallen to 40.6, the lowest since the pandemic. Energy costs have surged since reducing dependence on Russian gas, while an aging population and labor shortages strain productivity. Also, stricter environmental regulations have impacted industries like automotive and chemicals. This stagnation could ripple across Europe, as Germany is a major trading partner, potentially dragging down EU growth. The European Union cannot have economic growth in the long term without a stable and growing German economy. Globally, weaker demand from Germany may reduce exports from countries like China and the US, amplifying concerns of a broader EU economic slowdown.
Very, very bearish to me. Oh, man, Europe is always a problem. Always a problem. Well, let's talk about natural gas. Might as well talk about it since, Europe doesn't like natural gas no more. One of the cheapest ways to get your energy. But hey, they want to blow up pipelines and whatever and fight Russia. Go ahead. You do what you want to do. Let's show some good news for natural gas. Let's see. Here we are. Let me find it. Oh, it's not on this folder. It must be yesterday's folder. Okay, here we are.
Manali, thank you for joining us. It's great to have you today. We're going to start right there with your earnings because record EBITDA, margins growing despite that top line miss that Sarah just mentioned. What's enabling you to grow profitability even as energy prices have fallen in recent months and over the past year?
Well, thank you, Morgan. Great to see you. And again, this is the continued execution of a strategy that we've laid out at Baker Hughes, which has really been built on transforming the core and our operational excellence and efficiencies, continuing to look at new areas of investment with regards to digital growth, as well as mature asset solutions within the existing basins, and then the growth that we're seeing in new energy. And as you look at the backdrop of our installed base, which continues to increase, and the services that we're able to provide that installed base. And we feel good about the performance, really proud of what the team's done this quarter and also what we have going forward as well.
Yeah, and you've certainly emphasized for a while now this shift away from the cyclicality of the energy markets. I want to get into things like IET in just a moment here, but first.
You heard that? The shift away from cyclicality. So energy stocks, quite boring in general, very cyclical, are not very favorited by Wall Street. That's why the XOK, the technology sector in the S&P 500, is about 32% when I went over that stuff like a month ago, at least like October 1st, I kept talking about it. And the XLE, the energy component of the S&P 500 is minuscule compared to that. I think it's less than 5%. So let's see. Are we in a new commodity super cycle?
Oilfield services, it's still your largest business. International was very strong, but North America continues to be soft, and we've seen the rig counts come down, even as U.S. oil production remains near record highs. Why?
Well, again, you've got efficiency and productivity that's happening within North America. And as you look at Baker Hughes, again, we're less cyclical than some of our peers within North America oilfield services.
we're much more focused on the production side. And so even though you see the rig count come down, you won't see that demonstrated in our revenues from a North America land perspective, like for like. And we're buffered from the production and the chemicals that we provide in the basins.
What is driving the strength internationally? And I ask that knowing that you've got a softer economy in China, which is certainly adding to fluctuations in oil prices globally. You've got two hot wars, including one in the Middle East and obviously in Ukraine. How are you navigating those dynamics, and where are you seeing that growth continue to come from?
Definitely, international is an important part of our business, and we're seeing continued strength in some of the areas of the Middle East, as well as with Brazil. And we've been focused on some countries as we look at Qatar, we look at UAE. Also, clearly, there's been some downward pressure by some of the activity decreasing in Saudi and less than what we expected. Overall, though, again, for 2024, we see international at high single-digit rates. And as we look at 2025, you know, global upstream spend will be in line with what we've seen in 2024.
Okay. So let's talk about the IET business. This is the industrial and energy tech business. You're making turbo machinery. You're providing support services. This is tied to things like LNG and hydrogen and carbon capture. This business is growing. Margins are growing there. What is propelling that? Is this energy transition? Is this electrification? We're increasingly talking about AI infrastructure build out as well. Does that play a role?
It's really an all of the above. And as you look at energy demand, and we spoke about it on the earnings call this morning, between now and 2040, we see energy demand increasing by 10%. And as you look at natural gas being 20% up and LNG being 70% up. And this is core to the equipment that we provide. And that's why we're seeing a decade of continued strength and growth as we go forward with the equipment and also the services that we provide to our customers. And just to mention, Morgan, the EBITDA margin. Mention, Morgan, the EBITDA. We provide a margin rate improvement across both segments as well. We see that.
Yeah, I don't know. I don't know why StreamYards does that, where it just pauses everything a few seconds before it ends. It keeps doing that for some videos. Some videos it doesn't. Very annoying. Anyway, short point is that things are growing very nicely. And Baker Hughes, BKR, which is kind of like the corollary to the VRT stock we were covering earlier, the Vertiv, where they do equipment, the equipment to the, so VRT Vertiv does equipment to the data centers for cooling. The BKR, Baker Hughes, is like doing it for sending equipment to the oil producers, gas producers, right? So this is what I'm just saying. So there's many little subsectors. You should be aware, you know, about these things, where you are on the value chain, the supply chain, everything, and how you integrate. But let's just look at the commodities right now. And one thing I want to mention is that futures close around 11:30 my time. So it closes 1.5 hours earlier than where the stock market in general closes. So futures market usually, yes, that's where most of the activity ceases. They'll still trade, but yeah, everyone who's has already done most of the settlement with the contracts, they already left. They already went home by now. So they'll in 1 minute they'll go home in the future. So the Chicago Mercantile Exchange. So let's look at the natural gas right now. So you see that. So it hit that bottom of that red area that was set in December 2023. So this is spot prices. These are spot prices. Now, I can also look at the futures price here. So it's a little bit different, right? You see. So But in any case, we're making a higher low here. So I'm trying boil again. So yeah, I got in at like 8 to 10 here. Way back when in July and August or whatever, I forgot. Somewhere here. It was August, I guess. Yeah, August, July. When it went up here, it just didn't make it. It made to the top. Now it go back. I had to sell. Now it went back to 8 on Friday. I said, I'll try it again. Now it's going back up. Now, the only problem I got with this is that when you do, let me zoom in here. When you do natural gas, you have to follow the seasonality. Usually the up move in natural gas ends at the end of October. November will be a shoulder period between fall and winter. So that's kind of like uncertain. It might still go up. It might not go up. It might just start going down because we're done with building up storage for the winter. And demand is over at that point. They filled up all their tanks. Everything's ready to go for the winter to give natural gas to the very cold areas in the East Coast. The New England area specifically, because that's where the population density is, where the cold is actually. And so, even if it gets cold in the places in the Midwest or Texas and Montana, that's not where the population density is. So most of the natural gas is driven. Yeah, you got to scalp oil. You can't. Unless there's a big trend. I'm hoping for a trend still, because at this point, this is a big base right here. So there'll be a point, because if it doesn't start moving up and break out of this area here, $3 a million BTU British thermal units, if it doesn't break out of this area anytime soon, then yeah, we're just stuck in this range until early spring. So the next time you're gonna try boil and try to hold it for longer than a month or two is when you think it'll break out of here. So towards the summer. So essentially you're thinking the summer of next year is going to be where it's going to be big. So that's where I'm looking at. It'll try to get back up here, maybe before Thanksgiving, perhaps, and then it'll fail again and go back down. So that's what I'm thinking. But who knows? Maybe it'll try to get through it a little bit more, but from that point on, it'll stay stuck and go sideways. And you don't want to stay in boil at that point. Yeah. So that's about it. You'll probably buy cold. So that's the opposite of boil. KOLD is the bear one. So yeah, you can. If it goes up here into the winter, then yeah, you could try cold, because then it'll just fall back down. Okay, that's what you would do. That's how you would trade it. But the real way you would trade is with futures. You shouldn't be doing it like this with the ETFs. But for people that can't do futures, or just too lazy to learn about them, because yeah, you have to really understand futures, and you screw up on futures, yeah, you could lose your ass. And natural gas is not to be trifled with. Like, a few point move in natural gas could be like thousands upon thousands of contracts, and you're gonna be like, what the fuck? Your whole account just blew up in one day. That's why they call natural gas the widowmaker. Okay, so of all the commodities to be trying, do not try this one first. Like, you have to try a beginner's commodity. Like, this is not a beginner's commodity to trade, because every day there's a new weather forecast. So throughout the 24-hour cycle, there will be like 4 US models of weather that comes out, and 2 European models of weather that comes out. So then you got the European, the US, all the weather models, and that all changes, and you could see like swings going up and down like crazy, and you're like, what the F? You can't make heads or tails of it. So that's real casino action right there. You don't need earnings. Like, throughout the day, there's earnings every several hours. That's just how this market works. So that's why you see these huge moves that make jagged patterns like this, like intraday. So you can just zoom in. You can see like boom, 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 boom. Like, each of these moves here, these candles could be thousands of dollars each movement. And if you guess the wrong direction, you're like, oh, I'm a short here, and it just blows you out of the water. Oh crap, okay. And then you just like, yeah, forget it, dude. I ain't doing that. You want to do that? Yeah, go. You could go to a class or something. Somebody could teach you that, but I doubt anybody could teach you that correctly. But yes, this would be better than Bitcoin, probably as a futures market. Yeah, you'd be like, whoo, yeah, the Widowmaker. But in any case, I'll see what it does. See if Boyle gets back above 10 again. See how it does into Halloween, and we'll go from there. Try it again. Itsy bitsy spider goes up. Try it. But as you can see, there's structural changes in energy. So I think for the coming year or so, yes, Boyle would eventually go up. You just got to find the right time. You just can't hold it. Yeah, the other thing I got to talk about to you guys too is I mentioned before contract rollovers. So the ETF has to roll over contracts. That means it has to sell the current front contract, buy 2 months ahead contract, and that causes depreciation. So when you see the Boyle chart, it looks different from the futures chart because of the fact that, like, see, it made a higher low here than August. So it made a higher low in mid-October compared to late August. And then when you look at Boyle, it's making a lower low than the September area here in late August. And the reason why is because they rotated contracts. So that's another bad. So it's leveraged. One reason it's lower, and second, it has to contend with contango. So I haven't talked about contango, backwardation. Like we mentioned it on John's. John mentioned it, but he understands that because he had to do bond trading. He had to work for a company that did bond trading, so he had to learn that. So that's why you have a curve. That's what they call a curve. Okay. So that's why you have contracts out in the curve. So then you got like contango, backwardation. Yeah, I don't want to get into that right now. You're going to get so confused. So yeah, futures is not something to be playing around with unless you really understand how to do it right. But if you're scalping, it's okay, but if you're trying to do long-term holds on futures, you have to structure your contracts correctly. Like, which contract to short, which contract to go long, blah blah blah. Yeah, you're good luck. That requires a lot more skill than I could ever understand. I just want to make money the easy way. Like, I don't need to work my ass off to understand that. But for now, yeah, well, let's see if there's a super cycle coming in for natural gas, and that's where I'll be playing it, not doing the hard work of scalping anything. So let's go on to our lessons. So let's do the first lesson of the day. So I'm going to play a video here for you guys. I think that'll be better than me telling you anything else, because I think he does a pretty good job of it. Let me find it. Ooh, hopefully this doesn't slow down my computer even further every time I share a video. Okay, let's hear this.
Markets, and you can generally look at this on any stock. I'm going to start off with, we'll take a look at a few here. So here's Facebook, which obviously just changed its name to Meta Platforms. And what I've done here is just simply draw nothing but horizontal lines. And the horizontal lines are usually at a high or low. And if I've got two lines of the same color really close together, it's generally that they both created a support zone or resistance zone. And the trades here that line up more times than you can imagine are something like, well, here, let's start here. This orange line was the lowest low in January. It's never, the market hasn't come back. You know, Facebook hasn't come back to test that level. Here you had highs. Now, why do I have two lines here? I do this because when you've got a high followed by another high, and that second high is a higher high, but it closes lower than the day before's high, then I'll kind of look at both of those highs as being potential resistance and not just the highest high. And again, that's because the day that made the highest high actually had a close that's lower than the day before. So I look at these two consecutive highs kind of as important. What I'm saying is that when you, and we'll take a look at the blue line in a second, when you come back and test either the high, or in this case, this double lined high, you often get a quick trade in the opposite direction. Now, in this case, it really only lasted a day. Usually you can get 1 to 3 days fairly safely from one of these type trades. Here we had a high, sold down, sell down notice was the same as the lows. So quick trades leaning on horizontal levels, right? There's no, I'm not, in the examples I'm going to show you, I'm not using trend lines, I'm not using moving averages. I'm simply showing you horizontal levels. Why do these tend to mean something? Because algorithms look at what prior highs and lows are and set their orders and keep, especially the high frequency traders will keep leaning on these levels until they're proven wrong. So you often have company when you find a prior high or a prior low. Now, there's lots of little interim highs or lows too, and like, how do you know which ones to use or which ones not to use? So what do I typically do? We'll look at, as a minimum, I generally want to see a higher low that I'm looking at, having 5 days on either side of it not exceed, let's say in this case, the highs. So I want to see that I'm on like a 5-day high, and then I want to see it at least sell off so that that high stays a high on either side of 5 days of making that high, right? It's the highest high leading into there for the prior 5 days. It's the highest high in the subsequent 5 days. Doesn't have to be 5 days. It's just a number I'm often working with, somewhere around there. I just want to get some sense that a high is still a good enough level as a high. And so, for instance, this high here sells off, comes back, tests it.
So you got to understand that point. He's saying like he's only picking highs or lows where they make some kind of 5-day left or right of it, where they so okay. The next video I'm gonna show, this person's gonna talk about the zigzag. So just keep that in mind on this video. This person is saying like he's eyeballing it. He's saying like if he sees 5 days where it was like the highest high, and 5 days before, 5 days after, the highest high, highest low, I guess. And he's saying like, okay, that's a major top or bottom that he's drawing a line from. So take that, keep that in mind. And the next video, the person is going to talk about zigzags. So this one, there's no zigzags. Just keep in mind this, and then refer to the zigzag video I'm going to show later. All right, put a note.
Now you have a close little through it. So how do you stop yourself? I'll usually use, on something like this where I'm leaning on a level, 0.5% to 1.5% is my stop. And so on a $330 stock, we're talking about, $3.30. Well, anywhere from $1.50 roughly, $1.65 to could be as much as $5. And again, looking for a quick trade of 2 or 3 days, or like I say, a trader's trade. I'm not saying this is going to be the high and that I can sell it here and buy it back down there. I have no idea. What I do know is that this high here is surrounded on either side by 5 days that didn't exceed that high. And therefore, I probably have a chance to lean on it. And again, a quick trade. Here's a high, pulls back, tests it again, pulls back, tests it again. I can't tell you I'm going to hold it down here. I just know there's a quick trade in here. Here's a high, and I would have, if I leaned against that high, I would have been stopped out probably right in here. On the way down, Here's a low. It makes a lower low and closes up. So I'm going to take the day before and the day of the low and say there should be support in here if we come back and test it. Here's a high. Let's see, 1, 2, 3, 4, 5. Close. The 6th day came back and tested it and sold off. So again, if I hold this for a couple of days, I'm making money. And this one, in fact, is where Facebook's trading right now. That's one example of a stock that generally moved higher. Let's look at something that's moving lower, like Peloton. So here was the high in December for Peloton, sells off, makes a higher high, but notice doesn't close above, close to whether or not you get stopped out here. If you do, the good thing about this is if you're wrong, you take a really small loss. If you're right, sometimes you catch a good move of 2-3 times what you're risking. We sell down here. Is this low have 5 days that came into it that were higher lows? Yes. 5 days after it, yes. So I'm going to take that. So we come down, test it, and bounce over the next few days. Again, quick trades, not staying in these. These are traders' trades. Eventually, Peloton sells down. Look where it stops against the November lows. And it holds there for almost 2 months in March, or certainly a month and a half before it broke. All I'm saying is, if I buy into this zone, a couple days later, I'm up $20 on the trade. What was I risking? A few dollars. Now I have, a level here to lean against. If I leaned against it here, I have a day. No, I guess not even 2. Second day, you would have been stopped out, and I get a higher high. I know that's a level to potentially lean on in the future, and so on. Let's here. Look where we came back to. The same lows that we saw in early October were the same lows of May. And that's the current picture. So you're not going to make on every one of these trades for sure. But if you do them consistently, keep your stops anywhere to 0.5% to 1.5%, generally you're going to come out ahead because the market comes back and revisits levels time and time again. You could do this. Where did I set this up? I think it was IWM. Yeah. All right. So the Nasdaq, not the Nasdaq, the Russell 2000. This was in a trading range for 6-7 months, something like that. There's plenty of times that it comes back and leans on levels. Here you would have lost, makes a new high, comes back, tests this low, right? So if you bought this within a day or 2 or 3, you're making some very solid money. Comes back, tests what had been the prior level, comes into the zone. Now, again, this is easier than most because this ended up being a pure sideways thing. And we had the breakout that all the technicians, including myself, looked to be a significant breakout. We're certainly getting challenged on this now, whether or not this is a valid breakout or not. There's even, let's see.
And I'll make a note of that was an invalid breakout because after it fell back, it broke out and it fell back down to there. It just continued going down from there. And this was ahead of the 2022 correction with the large caps. So, yeah, you would have had an early warning of what was going to happen the next year if you looked at the small caps doing like this.
Short-term trend line probably is, yeah, even that broke yesterday or today, actually. That's today, real time. So the idea is pull your charts out, draw horizontal lines at key levels. And if you're a pure trader, you can trade against prior highs and lows and generally get, if you control your risk, like I'm saying, you can usually get stopped out with a small loss. And if you're right, you're going to make more than you lose. And that's kind of just one way of looking at a trader's trade, is leaning on a level, looking for it to hold, stopping yourself out quickly after if it doesn't hold, and looking for a quick move to the opposite direction over the next couple of days, and then that's it. You close out. Let's say you bought this here, and in a day or two you're up as much as $15, something like that, $12, $15. I'm not going to play and keep holding and holding. I have no idea if we're coming back to the range or not. I'm just saying that you can often lean on levels that are significant highs or lows against prior highs and lows and get a sense. Now, could you add an RSI into that formula? Sure. And you can quicken your RSI because you're looking really short term. So instead of, most people default to a 14-day RSI. I will ask you, why are you using 14 days? And you're going to do it because that's what generally most technical systems default to. Because Wells Wilder, back in, I think it was the 1970s, when he came up with relative strength index, decided to use 14 days. I can't tell you why. I've never seen any reason why 14 days is a good level to use. It's not even half the trading days. It just, to me, makes no sense. So I use 11 days, which my default is 11. It's half the trading days in the month. I think a much better way of thinking about something. And if you're trading really short term, I would even cut it down to maybe, I don't know, 6 days, something like that. And you're going to get a much, so here, if we just take our RSI chart, modify it, cut it down to, let's say 6 trading days, this is going to get much spikier. But if you get overbought or oversold, at the same time you're hitting these levels, you might find it's a much better way of being able to time for a short-term trade. So anyway, that's just something I wanted to teach you, and it's in coming up with levels to lean against, risking a small amount to play for a quick but bigger move in the opposite direction. All right, so that's that. Let's take a look now, go into just getting some overview of the market before.
All right, so I'm gonna play the next video. Now you have to remember, like, how do you determine those tops and bottoms? Where you put your levels? Like he did it by eye. So let's see what this other person does.
This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabel. So what we're going to do today is answer some questions. I've gotten a number of different types of questions related to the Fibonacci retracements, multiple time frame trading, understanding how to identify entry points that might be a little bit more on the aggressive side. Okay, so we're going to put all this together, and I'm going to show you an example in Apple of how you could have recently been more aggressive on your entry point. So we're going to do that. Now, if you want to learn the reason why I switched this, so monthly here, that like button, and also subscribe. So I've got my charts up of Apple. All right, it's a grid. It's the same time frames. I've got a monthly here, bottom left, bottom right is a weekly, daily upper right, and an hourly in the upper left. Now, what I've done different is I've taken off the MACD and the ADX. I just have the volume at the bottom, and I do have the moving averages up, the 18 and 40 simple moving averages on all the time frames, but I also have overlaid the zigzag. All right, now let me just show you this so you can see. Wait a minute. Zigzag. All right, so I'm using a percentage of 5. I've got it set to auto percentage. This is for anyone using stock charts, ACP. All right. The multiplier by default, if you bring up the zigzag, will be 2.5. I have switched it to 2, and I use the high and low. All right, off the close. And so that's basically how I have this set up. Now, the reason why I switched this from 2.5 to 2 is I'm based on my style and what I'm trying to do when I'm looking for multiple time frame confluence. I need a little bit quicker reactivity in the swings. I need a little bit more aggressive reversal points than the 2.5. All right, 2.5 is a pretty good standard average true range move off of a low. That's what Linda Raschke uses. I don't have a problem with that. And the way she has her multiple time frames set up, it makes sense to me that she's using 2.5. But for me, and the setups that I use, it is really, I think, worthwhile to use the the 2 as a reversal point, as a multiplier. All right. Now, let's just start with this monthly chart. We can see we're looking at a longer term uptrend in Apple, and it had this pullback back towards this 200 area. Now, we want to look for confluence. If we're going to be an aggressive buyer.
So you heard that, confluence. That's exactly the terminology T-Spells uses when she was talking about multiple time frame. That was like, I don't know, maybe like 2 months ago. So she was talking about how she does her trading, and you saw that multiple time frame confluence. Okay, and we talked about the zigzag. So unlike the previous presenter, who was eyeballing what the top or bottom is and drawing lines, you see here this is more automated. We're using the zigzag function, so you can look that up yourself. I might cover it again sometime down the line, but yes, you can use a function called the zigzag in any charting program. Set it up the way you like it, and it will try to find what's a top, what's a bottom. Maybe it'll work out better for you. I usually like to eyeball things myself. Some people, maybe they want it more automated, but like I said, the future is in pattern recognition. So maybe when we start doing something with AI to try to find where we should trade, yeah, using a zigzag would be beneficial to the work.
Near support. We need more than just price support. You know, we can't just be looking at one thing. If I'm going to play it more aggressively, I need to have other aspects that are telling me, you know, other indications that suggest that there's a pretty high probability we're gonna move back up. All right. Number one, we've got a rising 18-month line right underneath this 200 mark. All right. Now, not only that, do we have a rising 18, but we have a rising 40 right underneath it. So that tells me we've got a decent trend in place on this time frame. Now, I'm not even looking at the momentum indicators. All right. But I can see that the volume really doesn't look that bad. It's not like it was violent selling as it came back towards this 200, just under 200 mark. And again, came very close to the 18-month line. All right. Now, that's trend support on the monthly. Trend support. Trend support means I'm getting a pullback towards a key moving average. And a lot of times that'll define price support, but price support is a little bit different. Price support is where we can look at 2 to 3 level reversal points, right, at the same level. All right. And so I can
see how he did that. He used the zigzag peaks to draw that support line. Okay, so he's saying the monthly has an upward trend, and then the weekly is kind of going sideways, and we're trying to find where the support resistance is. So remember that.
See, we reversed here to the downside. We reversed again here. So once I see that, I can draw a horizontal line at this level. Now, we did get a third just underneath the 200 mark, but I know basically right in this zone here is a pretty important area to be watching. Now, that is separate from trend support. So we have on one time frame given us one thing, one piece of information, and then we have another time frame giving us another piece of information. So we have trend support on this time frame. We have price support on this time frame. It doesn't hurt. We have trend support too. You notice how we have a rising 18 and a rising 40. This is multiple time frame confluence. This is what we're looking for. We've got a lot of information sort of suggesting that this 200 area, not an exact level, but the 200 area is likely to find some support. Now, the other thing I would point out is that look at what's taken place. You see the lack of volume in this decline. There wasn't a lot of volume associated with this drop. That was a sharp drop, and it didn't really lead to a lot of heavy volume. All right, so we've got all that in our back pocket. These are the bigger time frames, and we're not trading off these time frames, but we're going to use that to our advantage. Now, there's two other aspects to this trade that will, or this setup that will allow me to go down to the small time frame hourly and be more aggressive. All right, one of the things I'm looking for is our classic A, B, C decline. All right. That is where it's a corrective pattern and not necessarily a reversal. Now, this is really important, your understanding of this. This is right out of my course. I don't go into this in the book because it's too in depth, all right? You will find that the courses have a lot of detail in them. But I've got this decline here and then a rally up, all right? So this is a key low. If you notice, when we drop from here, we did not take out that low. All right, we went to a higher high, but we did not go to a lower low. As a result, this now becomes an ABC corrective pattern. So I'm looking at it as a move down, a rally up, and a move down, and that's it. It's no real reversal. A reversal would be is if we go and we turn down through that low, come back up, make a lower high and a lower low. The other way you could do it is if you made a lower low like this. First, you made a lower high, then you make a lower low, then you make another lower low. That would be your second lower high, second lower low. That's another way to reverse the pattern. So we don't have either one of those in place. So we view this as a ABC correction into trend support, into, price support, into trend support. It's actually both trend support and price support based on the moving averages, and then trend support on this time frame. So we've got one piece of information, we've got another piece of information, we've got the ABC, that's a third piece of information, we've got the light volume, that's 4, right? That's 4 different little indications that suggest, hey, this is starting to get pretty interesting. All right, now look at what we want to do. Off of this bottom to this top, and I drew it on this time frame so you could really see it, from this low to this peak, we do a fib retracement. Now, what we're looking for, and I don't know why, I must have gotten rid of the 38% retracement, but I want it to be inside this grid. This would be the 38%, 50, and 62%. So we want to see the reversal come into that zone, right in the area, preferably right in the area of the 50%, which is essentially what happened here. If we have that, combined with the fact that it's an ABC correction, combined with the fact that we have trend support, price support, all right, and light volume on the decline phase, then I can now go down to this small time frame and look for entry. Now, I wanted to show how we use the swings. This is how my subscribers have learned to use the swings. I think this is really important. If you notice, this went to a higher high on the hourly. In fact, I want to zoom in on this for a second. So we know we've come down into this zone down here. We've come down into the zone. We know we've got trend support on the monthly. We've got price support on the weekly. We've got a ABC correction on the daily, and we're coming into the fib retracement level. All right, we're coming down into this level. So what I'm looking for is price is going to give me the first indication that we've got a reversal in place. And if you notice what happened, we went to a new high on the swings, we went to a higher high here, and then immediately to a lower low. All right, so that's bearish. We went from a new high to a new low. That is a bear alert. Bear alert. All right, the moment we go to a lower low after a higher high, remember, we're looking for this pattern. So that's a bear alert. And then when we rally up, we're on the lookout to see if we do something like that. Well, if you notice what happened, that is not what we did. Instead of going to a new low, we went up, we came down and tested just like this, all right? And then when we turn back up through this prior high, that is actually a failed bear, all right? This is a bearish pattern, and now we have a failed bearish signal. Now, if you notice, we went into the zone and we found support at the 18 as we were trying to come out and then turn back up with a green bar, big green bar crossing up through that level. All right, so I know this is a really key level. All right, you want to know that. I also know that we came back up through the 18 and the 40. We also have a big green bar. Do you see how all this information, this is all information that I'm getting without the use of any indicators. I'm not saying not to use the indicators. What I'm saying is that the majority of this setup has come from looking at price support, trend support, fib retracement, knowing that we're looking at an ABC correction on the daily chart, and this is just a simple pullback. So that's essentially a pullback in an uptrend, and this is a corrective pattern. All right. And then we also know we have lighter volume. We have this fib retracement zone, and now we have a failed bearish signal on the hourly. I can get long as this comes back up through this low. And I can also know that if you go through my course, you'll know that this pattern is what I call a spike and ledge. All right. And it is crossing back above this peak as it's coming back above the breakout point at the same time. So this is a spike low followed by a ledge coming back up through would be the buy signal. We've got multiple reasons why this would have been a decent buy pattern somewhere around that 212, 215, something like that. Now, in this instance, because of how far it was off the low on the daily, my suggestion would be to take the risk off the hourly, meaning when we put this trade on, use hourly risk, use maybe the last key low on the hourly as your stop out point so you can keep the risk down. And if it's going to turn in this situation, it's just going to go. It's not going to hang around down here. It's not going to fiddle around. I think it's the type of situation you're coming into a key level. You should get a strong retracement pretty quickly. So anyway, these are how to put some pieces together that can give you a pretty strong evidence using multiple time frames to get you really good entry on a sharp downside.
All right. So that was pretty good. That was a pretty good explanation right there without using any indicators. So Tropes here, yeah, he got his indicators. He has his time frames he's looking at. Exactly. So, and I'll tell you this, Tropes, like all this stuff is useful for long-term, short-term, doesn't matter. If your system is really good, it should be fractal. Meaning I just change everything from what you said here. You said you do 1 second, 1 minute, 50 minutes. If I change that to 1 hour, 1 day, 1 week, it should work the same. It should work. So if the system is really good, all that stuff you're saying right here should work for a larger time frame. And that's why I tell people investing, trading doesn't matter. It's all the same shit. You just use the chart and you do the same thing. You're just doing it in different time frames. And that's all it is. And you decide what time frame you want to play with. That's all it is. And that's why cycles, when you do cycle analysis on top of the technical analysis, that's when you get really good, because we got more advanced stuff coming along. So the foundation of the study of cycles is doing more advanced algorithms. So we are going to do things that other people back in the past, in the old days, that was considered astrology, is now going to be something we can do and apply for modern day times. And so, yeah, that'll come up later. We are at 12:07 my time. So it's going to be less than an hour till close. 4 p.m. Eastern is closed, so it's 3:07 Eastern right now. I don't think anything has changed with regards to how the market's going to do. I think anything from here on out will be determined by all of the big earnings next week. There is no big data tomorrow, except for maybe the University of Michigan survey on consumer confidence and inflation. That's about it. I don't think there'll be any surprise or any big shockers there. And, you guys need to donate to the Halloween contest. That's definitely sure. I got to put up the banner. Here you go, the banner. I got this whole thing with what else I got? Yes, Halloween is 1 week, right? It's 1 week from now today. Yes, it's 1 week from today. The Urban Landlord presents Haunted Hotties Halloween Beauty Battle, October 31st, 9 p.m. Eastern, 9 p.m. Central, 10 p.m. Eastern. Ladies, enter for your chance to win. All right, so I don't know. We're still going over the rules a little bit here. We need to get more money. All right, guys. I don't know what the updated pot is, if it's still below 700 or not. That's only halfway to where we want to be, right? That's below half where we want to be. So donate. Any donation counts. Just anybody giving a few bucks here or there, go into the pot. That's great. please do it, because we're gonna have a real fun time. And you never know. I mean, John wants to do like a rental. Yeah. Well, tropes. Okay, you talk about like, I'm looking for 1,000% over many years, so I don't need to pay the taxes. And if you do leaps, and you got 1,000% just on the stock price, and you do a leap option on it, how much is that? And you don't, and you get the benefit of having the tax benefits of that. That's where the money's really made. So I don't know. It depends on people's capitals. Yeah, I have a lot more capital than most. So obviously, like, yeah, if you have very little capital, you got to do the scalping thing like every day or every other day or whatever like that. So yeah, it depends on the situation, I suppose. Yeah, everything, it really depends. Because like if you did the VRT stock, like, that was like 4,000%. Was it no, it was 800%. Around the same time period as Bitcoin going up 200%, that stock was an 800%, right? And then you don't have to pay the tax. And then you did a leap option on it, yeah. If there was any leap options existing, that was good for that stock, yeah. So that's why I say it's like you gotta make your plans of how you want to approach the market. Everyone's unique. Depends on your tax situation. Depends on your capital that you can expend on stocks. Depends on if it's in a retirement account, a tax deferred account or not. Everything will come into play of how you want to play the market. But my idea here is that you have to have a philosophy or methodology that can be applied to anyone. It shouldn't be something that only applies to one particular type of trading. If that's the case, then that could be gamed out eventually. You want to have something so general and adaptable that you can adjust it to you. And with the whole thing where, yeah, eventually I'm going to have to probably like private all this stuff, like, because I'm giving you too much information. Because yeah, if I develop a system that really works well on long term, day trade, all this stuff, yeah, that's over. Then we have to shut it down. Like otherwise, if everybody knows how to do this, then the edge is gone. You got to keep your edge. So that means you can't share it with people anymore. Anyhow, so yes, we will have the Halloween contest in a week. Please do donate to Portia. Okay, Cash App Portia J. Man, yeah, come on, like PORSHAJAYE, $, right? That's the Cash App, or PayPal, or contact info at PORSHA@JGHB.info. Okay. Yeah, so I can't teach you that stuff with options, but yes, you will have to learn and go from there. Yeah, with a small account, yes. But anyway, everyone's situation is different. Yep. Figure out your situation, but definitely never stop learning. The markets never stop adapting. We are in for wild time in the coming 5 years into 2030. Believe it. Believe it. Especially if we're entering another inflationary period that will just blow your minds, because then it will be really hard to make money. You got to make money where inflation can't hurt you, and that's going to be real tough. A lot of you people, youngins, have never been in a period like that. Probably my parents have, but they immigrated here probably at the tail end of it. So by the time they got here, like, inflation was on the way down. But yeah, I think you're going to have to talk to real boomers about that time when inflation was a real big issue when it came to investing and trading or doing anything. All right, guys, I'll see you later. Maybe later today if I got time, because we got to go over through screeners and stuff. Because yeah, Tropes talk about screening, and I'm going to introduce the screener engine through the Wyckoff guys in the stock charts, and you'll see why I like that method. Very nice. It's very easy syntax, and you'll see what I mean. And from there we can grow, because I'm going to use that to update on searching through stocks and things like that for different types of trades, different type of time frames. I'm not going to partake in them, but I'm going to set it up where like every week from November onwards, where I'm just going to update like, okay, this is a swing trade, this is a day trade, this is a investment, or blah, blah, blah. And we'll see how it goes. And then from there, I'll build up a paper trading thing where I have different portfolios in my trading view account where I show like, all right, this is how my long-term account trade algorithm is performing versus this one. And from there, we can improve on it, see how much we can beat the S&P 500 over time, which trading algorithm works. And that's how you do it. That's how you do it. That's how a hedge fund starts. I personally never did like that. I'm lazy, but since you guys, I think a lot of you guys need to have more aggressive methodologies to make money compared to when I did. I just need to buy the dip and just rode it up. That's why I never need to look at such methods, because like you didn't care if you were like a little bit wrong, because eventually the stock would just go up. That's how things worked back then. But I don't think it's going to work that easily in the next coming 5 years, especially after 2030. So we'll see how it goes. I think this is the preparation. This is the real test. We are testing it out in the volatile times, and then we're going to test it out in the crazy times where stocks stop working. And, we're going through the cycles here. This is how you do the whole testing game. We'll see, man. So this is going to be a 2 to 3 year project starting from now. And we'll see if this is going to work for the next coming decade into 2030 plus. So whatever we develop now in the coming 3 years should work in 2030 and beyond, when we don't know what the world's going to look like. I'm not going to say it's World War III or anything like that, but you got to be prepared for the eventuality where the US dollar is not dominant, and the treasury bonds are not being used to escape the debt that we're doing. I don't even believe in Social Security or even Medicare, to be honest with you guys. So I don't believe I'm going to get those things when I get old. So for you younger people that are below like 40, shit, I don't know what to say. Yeah. So, all right, guys, with that rosy note, with that optimistic tone in my voice, I'll see you guys the next time later today, or maybe tomorrow. I don't know. We'll see. Depends on my mood. Bye-bye.